adjust this properly here. Good. All right, we're Gucci land there. So, um, what else? I think we should probably jump into the module, but let's check the market. So I'm gonna chime you in a little bit, okay? So I'll be right with Zach. Let me see how I can do this. Um, I'll hit you right back. Yeah, just let me, once I get through, I'll hit you right back. All right, started. Go on, say. Radar Plex 3. Okay. Um, let's go YouTube. Go home, go search, go Bloomberg, go channel, go videos, and Asia Trade.
For tight spaces, a set of 7 notches fits various host screws.
Well, I guess we'll do the full exam. You guys have a pop quiz. Let's see who's been paying attention in class. I want to see 5 pages of notes, put it on closed caption.
This is the Asia Trade. I'm Avril Hong in Singapore. I'm Heidi Stradwatts in Sydney. The top stories is oil markets are set for further chaos and crude soars above $100 a barrel. The war in Iran forcing Gulf producers to curb output and divert exports away from the Strait of Hormuz. Asian stocks are set to tumble. Iran picks the son of Ayatollah Ali Khamenei as its next supreme leader, taking over after his father was killed in attacks by the US and Israel. And President Trump said to be considering deploying U.S. special forces on the ground to seize Iran's near bomb-grade uranium amid uncertainty over its location. But first, lines crossing the terminal from the U.S. president talking about the oil prices and how short-term oil prices will drop away rapidly when the Iran nuclear threat is over. He's also talking about how it is an element of these elevated oil prices being a small price to pay for the U.S. at a time where, forget $100 a barrel, we are fast approaching 110 on both Brent and WTI after already what was a generational move last week in energy prices where Brent soared 30%. That was about $20 a barrel. And this is coming against the backdrop of both the UAE, Kuwait, Iraq even cutting oil output. We're hearing about the Saudis diverting record amounts to the Red Sea terminals. The U.S. Energy Secretary also weighing in, saying that traffic in the Strait would resume relatively soon. And we're seeing U.S. stock futures also declining rapidly at the open, 1.5% down after about 1 hour of trading so far. And volatility has been climbing. Take a look at these stagflationary impulse concerns that are playing out in treasuries as well. Asia markets are pointing to big moves at the open as well. Heidi. Yeah, April, it cannot be understated, really, the broad impact that we see of this oil shock playing out for Asia as we open up for trading at the start of this week. Take a look at how we're tracking when it comes to that staggered open here in Sydney. We're expecting that big boost when it comes to energy stocks, but really not much beyond that. Watching those oil companies, the likes of Woodside, Santos, some of the LNG names will be in key focus today across Asia. We see those gains as we see the potential exceeding of $110 a barrel for oil prices as we see those major producers curbing production due to the ongoing conflict. We're also watching, as you mentioned, the impact on sovereign bonds. Treasuries headed in one direction, really seeing that inspiration from Aussie bonds as well. 3-year yield jumping to the highest since 2011, I should say, on the back of the surge in the oil prices. Bond futures dropping as we see global yields trending higher as well. We're watching Japan stocks as well. Of course, a lot of those LNG names will be in focus, but in particular, we're watching for the implications of this oil price surge, energy prices weighing on the Bank of Japan that really puts at risk a potential early hike from the BOJ. Well, Iran has chosen the son of Ayatollah Ali Khamenei to become its next supreme leader. Mojtaba Khamenei takes over after US and Israeli strikes killed his father, the first time the Islamic Republic has opted for hereditary succession since the 1979 revolution. Let's bring up Bloomberg senior editor Wendy Benjaminson. Wendy, great to have you with us. And we had confirmation that a successor had been chosen yesterday. We've had now confirmation of who that is. This was a name that was being floated in the days leading up to this. Was it a surprise, though, because there were other strong contenders within the establishment too?
No, this really wasn't a surprise at all. This was the man that the U.S. really expected would take over for his father. As you say, it's the first generational succession since the 1979 revolution. And he seems to be the kind of guy who will continue in his father's footsteps in every way. And the Iranian Revolutionary Guard Corps, that is the elite military army that Iran has already pledged their loyalty to him. So I don't know if this is what President Trump had in mind in regime change. You know, he pointed out earlier this week that apparently U.S. and Israeli strikes had already killed the people that he wanted to take over Iran. And so this is what he's left with. And, you know, that leaves the U.S., even though the president, as you noted, said this is a short-term problem with the oil prices. But is the plan then to target Mojtaba Khamenei and then move on to the next guy and the next guy? We just don't know how they're going to achieve their aims here.
What do we know, though, about Mojtaba and his closeness to the IRGC? And in some way, does that inform how long we can expect this conflict to continue as the strife from Iran escalate?
Well, the conflict will continue, we think, until Donald Trump is satisfied that that Iran is incapable, or at least delayed, or at least he could tell us that he believes Iran is incapable of producing a nuclear weapon. But Mojtaba Khamenei does not appear to be. Now, of course, we in the U.S. don't know much about him, but from what we do know, he doesn't appear to be the kind of guy who's going to break with his father's rule and sit down at a table with Donald Trump and give up their nuclear program. It just seems highly unlikely at this point. So the war will continue. He's probably he appears to be, at least, as anti-Israel as his father was. He's deeply religious. He went through all of the training to become he is the highest rank. He does get the title Ayatollah, which is the highest rank that you can get in Shia Islam. And so it's a regime change without much change.
Yeah, Wendy, even some reports suggesting that he might be more of a hardliner than his father. Certainly not much signs of a reformist, engagement that could potentially speak with the U.S. What do we know in terms of President Trump, again, not taking off the possibility of boots on the ground? What are we hearing about the special operations?
Well, Bloomberg does have a story on the terminal today about how Trump and his administration is considering, but it's in the early stages, a plan that special forces would go into Iran, to secure the enriched uranium that would allow Iran to make a nuclear weapon. This would be far off. I mean, Trump has said, he told reporters yesterday that would only happen if they would face no resistance. And at the moment, that is not even a remote possibility. So we'll have to see, how that may change over the year. His press secretary was on our Sunday shows earlier today and said that he takes nothing off the table, from special forces to, regular forces on the ground to continued bombings. There's no sign of any let-up yet.
Peter Piper's pepper picking proved painful. So he ordered the supplies he needed from Amazon Business and positively prospered. Amazon Business, your partner for smart business buying.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets. Wendy, thank you. Bloomberg Senior Editor Wendy Benjaminson. Now let's get more on the surge in oil prices, almost reaching 110 a barrel now. Joining us is Sarah Vakshuri. She is founder and president at SVB Energy International. Sarah, it's good to have you on the program today. I mean, we are looking at the contracts on the front end approaching 110. What can perhaps provide a sort of ceiling? Do you even see one with oil prices surging in such a manner?
I do remember we had a discussion last week this time when the market was opening right after the war was broke between Iran, Israel, and U.S. So we started, the market was in the range of 70s, as you said. Right after 1 week, we are in about above 100. And last week, the expectations of the market was this is going to end somehow soon. It's going to be contained. There was no expectations of sheer impact on the energy infrastructure in the region and also production of the region. So what has happened, even though that the energy market showed significant resilience, and comparing it with the previous oil shocks, let's say in 70s, we have some changes. We have obviously multiple suppliers in the market, U.S. oil going from different routes, the alternatives that are not passing through the Strait of Hormuz, diversity in the market, diversity of different sources of energy all together, plus the data and access to data, the algorithmic pricing, all of that, if you put it as the resilience of market, and on top of all of them, China's stockpile of oil, which has been significantly, China in the past 2 years was stockpiling oil. None of them, as we see entering to the second week, stopped the market to surpass the $100. And why that is happening? Because we saw two major impact on the energy resources and flow from the region. Number one is the attacks and the strikes on the energy facilities in multiple producing countries in the region. And the second one is that the Strait of Hormuz, the oil flow from there, as even before Iran physically closed them, the insurance company kind of stopped insuring the tankers voluntarily not passing through the Strait of Hormuz, and that caused the storages in the producing countries to fill up. And as you said in your earlier report, the country's major producers start one by one announcing that they have to reduce their production because there's no way for them to store more.
And Sarah, what was interesting to me as some of these nations find alternative ways to get their crude around is how the Saudis are using their Red Sea terminals. You're seeing record amounts flowing there. Do you have a sense of perhaps among these Gulf nations which are a bit less vulnerable to these strikes from Iran and the impact on both infrastructure as well as getting their crude around?
Again, I like to distinguish these two from each other in terms of flow of energy. Definitely Saudi Arabia has the highest resilience because of the access to Red Sea, UAE to a certain degree, but in terms of the assets, energy assets being secure from the strikes, there has been some interesting things happening last week. So the first day of the strikes on energy infrastructure, Iranian foreign minister came to the media and said that the Iranian military, since the major commanders have been killed, is acting independently and in isolation, suggesting that already, whoever is ruling the country, the president, the foreign ministry, they have no access to the military. They are attacking and striking based on initial guidelines they had for defending the country when they go into the survival mode. Then toward the end of the week, we had Iranian president apologizing from the neighboring country and saying that this is not going to happen again, and they are going to contain they're going to prevent any strike. However, the strikes from U.S. and Israel on Iran have been intensified. They target Iranian refineries, the energy storages, and also a water desalination plant in Qesh, which later, when it was approved that the strike happened from Bahrain, Iranian retaliated on water desalination plant in Bahrain. So not only energy infrastructure, but food security, because a lot of the food to the region comes from the Strait of Hormuz, and also water security. It all there is a lot of uncertainty around it. And again, as U.S. is intensifying its attacks and strikes against Iran, all of this is just intensifying the risks against these countries, as the Iranian government is trying to reach out to the neighbors and try to somehow contain the situation. The more, the higher the intensity of the attacks gets against Iran, the higher percentage of potential attacks on energy infrastructure, water infrastructure increases in the region, which is really unfortunate.
Sarah, we heard on Truth Social from President Trump talking about the short-term price to pay being a short-term elevation in oil prices. We also had the Energy Secretary trying to reassure markets. Take a listen.
We have that oil. We have the world is very well supplied with oil right now. The United States is a net oil exporter. We're a net natural gas exporter. We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. We're communicating with our allies abroad. The oil is there. You're seeing a little bit of fear premium in the marketplace, but the world is not short of oil today or natural gas.
This year, we opened 2 new restaurants while running, how many?
5 others.
5 other restaurants. So we turned to Upwork. We found freelance pros to help with branding, digital menus, even AI tools to streamline operations. It was fast, affordable, and honestly a huge weight off our shoulders. Through platforms like Upwork, we found some freelance creatives who absolutely nailed our logo. Let me show you. Look at our logo. They also help with our menus. Where's our menu? They look amazing.
Incredible job.
What's really nice is that you only pay for what you need. There's no overhead. There's no long-term commitment. That kind of flexibility is what small business owners need.
The truth is, small business owners can really do big things. You just have to know how to get there, how to accomplish these things.
And asking for help, that's one strategy that we use all the time. Trying to build a small business or start something from scratch, don't let a small team or small budget stop you. Post a job today at Upwork.com.
Dual clutch, dual PPG. Dog box.
Trying to improve your credit scores can feel like a whole workout. Find ways to speed things up on Intuit Credit Karma. See the top credit factors holding you back and the strides you can take to move forward so you can work smarter and hit your credit goals faster. Download the app to get started.
And that's a big Notorious B.I.G. aka Big Papa.
So do you agree with that assessment? And internally within the US, how quickly can US shale ramp up?
So in terms of agreeing, yes, there's no short of oil because even the attacks on infrastructure did not really interrupt the oil production or export facilities. So it's really the matter of shipments happening from Strait of Hormuz. And we've seen that the U.S. administration, President Trump administration, suggested that they're going to reinsure and support both in terms of escorting and also giving insurance to the tankers, so the movement of the flow of oil will start happening again. But the question is that for how long? Most of this oil is not going to the United States. Yes, as it was mentioned by Secretary Wright, it's a global price, so it has impact on U.S. prices. But a lot of this oil goes to China mostly, and also a non-U.S. market. So for how long U.S. is going to insure those cargoes? So again, there's a lot of uncertainties. The oil is there, but when the security in the region, the risk needs to reduce, so the tankers could easily flow and move. So I would say, while President Trump wants to intensify and increase the intensity of attacks against Iran, on the other side, we cannot have the de-escalation or de-risking the threats against the oil, at least the flow of oil, and also the infrastructure in the region. So this cannot happen. On the shale side that you mentioned, definitely as the oil prices increases, and unfortunately the uncertainty and threats against infrastructure in the region increases, on the other side, it quickly incentivized the investment in the shale and also Venezuela, because now they're perceived as a very low risk investment and higher prices. So depending on how long these higher prices and the risk in the region is going to persist, it's going to be a big gain in terms of investment for shale and Venezuela, which is kind of Western Hemisphere's energy supplies. And production, also export. But again, what we see again with the leadership change in Iran and President Trump's announcement for...
Sarah, we're going to have to leave it there. We really appreciate your time for us. So, Sarah Bakhtiari, founder and president at SVB Energy International. Coming up, much more on how Asia is navigating the fallout from the war in Iran, these surging oil prices. We'll be speaking to Vanguard about inflation risks later this hour. Plus, a closer look at the energy pact on Japan with the Foreign Policy Research Institute. Much more ahead. This is Bloomberg.
How to multitask in the digital space. Stop believing that this is the real world. This is the fake world. The real world.
Broad weakness when it comes to Australian shares in the first 20 minutes or so of trade, other than those energy stocks. So take a look at what we're trading when it comes to crude prices. Is that really elevated level surging as major Middle East producers cutting back production? The Strait of Hormuz remaining essentially closed at this point. The US, in the meantime, has threatened to deepen the Iran conflict. It's already driven up prices of crude and nat gas. We're seeing that surge continuing into the Asian session. Of course, all of this is flowing through to fears of a more elevated, faster pace of inflation, in addition to the cooling that we saw in the US labor market data on Friday, potentially cause for concern as to what central banks will have to do from here. Some winners, though, clearly will be the energy names. You can see the likes of Woodside Energy, Santos surging in the early part of the trade, advancing after we saw that oil spike above $100 a barrel there. We've also heard that the UAE, Kuwait have started cutting back on output. As I mentioned, the Strait of Hormuz remains shut. Storage is rapidly filling up there as well. Let's bring Guthrie Reynolds, who leads our Bloomberg MLab Asia coverage, and who better to bring us, really the broad view of there is nary a corner of this market that's not feeling the impact now, despite, of course, at the start of this conflict, seeing kind of a slow start to panic.
Yeah, the markets were slow to price in anything even approaching a worst case scenario on as far as how long the conflict might last and how disruptive it would be. There were plenty of doubts as to whether a closure of the Strait of Hormuz, which only carries a fifth of crude supplies for the globe and a significant proportion of natural gas, that would be enough to seriously disrupt global supplies and send crude significantly higher. Those doubts have been wiped away now, so you've got investors rushing to price in something that they really had not perceived as a long-term threat. We have, after all, had years of lessons for dip buyers that big declines in risk assets are the moment to pile in because they'll come roaring back. It doesn't look like there's going to be a roaring back scenario for risk assets for at least a while, the way things are positioned now.
We were hardly paying attention to payrolls until they came and surprised the market. That, in addition to more elevated inflation prospects, where does that leave the Fed and really other central banks as well?
Well, at least the Fed very much sidelined. Concerns about this level of labour market weakness would seem to keep them away from hiking rates, you would imagine, unless things get even worse. But by the same token, what's going on with crude, and there's been a significant increase in inflation expectations for the US, that tells you that they're not about to cut interest rates, certainly not at this meeting. So, yeah, the Fed is going to be sidelined. It's going to be facing a very difficult set of outcomes. For the rest of the globe, it's just central bankers being pushed towards hikes. ECB hikes are being priced in.
For most businesses, hiring can take a long time.
Not for Susan, though. She uses ZipRecruiter to find quality candidates fast. ZipRecruiter uses powerful matching technology to screen resumes and find the top candidates. So Susan can quickly invite the best matches to apply with just one click. It's no wonder ZipRecruiter is rated the #1 hiring site. Spend less time hiring and more time building your business. Try for free at ZipRecruiter.com.
You're already online. Go to etags.com/FL and select your service, in your case, title transfer/registration, and go through our mobile-friendly app. Next, you'll answer a few questions about your Florida vehicle to set up your own personal account, like make and model, if you want a license plate with your transfer, and easy stuff like that. And don't worry, eTags handles all types of vehicles in the Sunshine State, from cars to trucks, motorcycles, even RVs plus motorhomes, and electric vehicles. That's it. That's how you transfer your Florida title online. No in-person visits, no waiting in line. A title specialist will guide you through the entire process, communicating with you through your eTags account. The next steps to complete your order, like uploading a copy of your driver's license or Florida insurance card. Are you ready to get started? Just go to etags.com/FL.
Gav, we have those data points out of the U.S. this week following on the jobs data, right? Some inflationary clues that are set to come through. But I wonder what's your sense of, amid all this, the extent in which we're going to see a really bad open for the likes of Japan as we watch for, the energy factor being a bigger consideration for markets.
Oh, absolutely. Japan, like much of Asia, is very dependent on oil and gas imports, and in particular oil and gas imports from the Gulf via the Strait of Hormuz, which is closed. So that's a major concern. You also have the broader impact where if you've got higher energy prices everywhere, there's not a lot of evidence that investors are seriously moving to price in the potential impacts on the AI boom of significantly higher energy prices and significantly higher yields. Those are both things that could stand in the way. We had Oracle deciding to shut down a plan for one data center at the end of last week. We'll be watching for other companies looking to trim back on some of those very large expansion plans. So you've got that going on. You've also got the private credit question that's become, very much more imminent, as it were. And Japanese banks are quite exposed to loans to the US, which could go south amid all of this turmoil. So I think we've got Nikkei futures. We're indicating about a 3% drop at the open. That's likely just to be, the starting level. There's plenty of potential they can go significantly lower.
Gav, thank you so much. Garfield Reynolds, who leads our Bloomberg and Live Asia coverage. Subscribers can also turn to the terminal for more on the Middle East conflicts. T-Live Go is your function for the latest. This is Bloomberg. Take a look at Australian bonds. Of course, we're seeing that impact when it comes to Treasury futures there as well. Bond futures dropping as we see oil sending global yields higher. Just one aspect of this global oil impact that we see as the market continues to deepen the chaos of $100, $110 a barrel oil there. We've seen the war really adding to the surge in oil prices. Brent climbed 30% last week, looks set to surge even further this week. The market's tagged to the region, already surpassing that $100 a barrel level threshold. We've also heard now the UAE, Kuwait has started reducing oil
production. Others may soon follow as storage fills up. Tankers are not going through the Strait of Hormuz, which is essentially inaccessible at this point. We're seeing the impact when it comes to bond markets at the moment, particularly when it comes to that 3-year contract falling 9 basis points, 10 years down 7 basis points for the Aussie. The Aussie also gaining there as we do expect sort of more commentary away from central banks as to how they plan to deal with this perceived inflation spike as a result of higher energy prices. More ahead on the Asia trade. This is Bloomberg. We do have some Japan labour market data. Real cash earnings year on year for January coming in at a beat at 1.4%. The expectation was for 0.9% and coming back from a contraction in the previous reading. Labour cash earnings on that year on year basis, 3% is the gain. Also better than expectations of 2.4%. When it comes to that faster pace than expected, we were already expecting that boost driven by hefty winter bonuses, some pretty solid corporate profits behind that as well. But that year-on-year pickup, as well as the real and the underlying readings, they're both stronger than expected. We do expect that the Bank of Japan's preferred measure, which takes out some of those sample changes, also continues to improve when it comes to continuity in this data as well. So that same sample data point at 1.9%, a little bit softer than expectations there. So whether the Bank of Japan will take this as an early signal that wage negotiations could see strong increases. Of course, so much of this when it comes to what we could get from the Bank of Japan, the risk to that next round of hikes could potentially be driven by what we see in oil markets at the moment, Avril, and the elevated expectations for inflation.
Indeed, and our next guest warns that many Asian economies could face higher inflation and slower growth if oil prices continue to climb. Joining us now is Tian Wang, Chief Asia Pacific Economist at Vanguard Group. Tian Wang, great to see you. So I wonder, what is your take first at $110 a barrel of oil, which we are now within reach of? What's that going to mean in terms of the scenarios for Asian economies, both on growth and inflation?
Good morning. Thanks for having me here today. I think, in terms of the macro impact, there is no doubt that higher oil price is actually a stagflationary shock, to most of the economies, is negative for economic growth and it's going to lift the inflation higher. But I would say in terms of the actual magnitude of the impact, it also depends on how long the oil price will stay at the current level, right? So that of the higher oil prices actually matters as well. We estimate that, for Asian economies in general, because this region is pretty vulnerable because most of them are, rely heavily, if not entirely, on imported oil and also heavily reliant on the supply from Middle East. We do estimate that every 2% of increase in oil prices will lead to about, 10 to 20 basis points lower in GDP growth and 20 to 40 basis points higher in headline inflation. So the impact is indeed there if the higher oil price is going to last. But of course, I would say every country is different.
Your small business taxes handled. All your unique deductions found. Keep more money in your business and take taxes off your plate with TurboTax Expert Full Service Business.
Mint's premium wireless is $15 a month, but I'd like to offer one other perk. We have no stores. That means no small talk. Just sign up online at mintmobile.com. It is an introvert's dream.
On that note, it's perhaps also worth unpacking. We know how consumers' fear of inflation can also tend to drive these price pressures. We're hearing in parts of Asia, people are lining up at pumps. What is that aspect going to mean for the pressures we see in prices?
Yeah, I think, there's like direct and indirect impact, right? And I think what you're describing is also this kind of inflation expectation, that actually can push the prices further up. But, as I mentioned earlier, every country is different, right? Because I think, one, it really depends on whether the country has strategic reserves that can help to stabilize the domestic price. And two, I think it also depends on the government, whether they're going to intervene, right? Either through subsidy, tax cut, or, there's different kinds of pricing mechanism in different economies that is going to limit the pass-through from crude oil prices to retail prices. And I think for Asia, the good news actually is that most of the economy actually at this moment experience low inflation, right? And domestic demand is pretty weak. So on that front, I think when central bank are looking at that, I don't think, high inflation is going to be their primary concern at this moment. So to that extent, I don't think they are going to react to the higher inflation by, aggressive tightening the monetary policy.
So to that point, do you think that it will be some time before we see a reaction from central banks in terms of how they tweak policy settings?
Well, I think let's put it this way, regardless what they plan to do, right? Either they plan to hike or cut. I think at this moment, all central banks are going to be more cautious with any move in the near term because of this heightened uncertainty, right? Geopolitical uncertainty, higher oil prices. I mean, obviously, stagflation and shock are always going to put central bank in a very difficult situation. But, given the uncertainty at this moment, I think their best strategy is just to wait a little bit, right? Wait for the dust to settle. So I think you do see last week, for example, Central Bank in Malaysia, they actually turned, more dovish. And then, like Singapore, right? We think they are actually the more hawkish one in this region. I don't think they are in a rush to tighten. Central bank in India and Korea probably will stay on an extended pause. And central bank in Thailand and Philippines, they plan to cut. We expect them to cut, but we also think they probably also will take a little time to observe what's going on before they, start the next cut.
When it comes to the PBOC settings and the Chinese government, we know that China has large exposure to Middle East energy, but are there also strategies and buffers in place there? Because we also know that they have pretty significant reserves.
Yes, I think, for China, we actually estimated the impact on economic growth will be rather limited, right? We only estimate about 5 basis points lower growth for every 10% of oil price increase. I think part of that is because China, one, as you mentioned, strategic reserve they have been building over the past several years, and two, I think China diversify the imports market for oil, right? So when we talk about Middle East, it's about 40% of China's total imported oil. And the other thing is that in recent years, I think China also was moving very aggressively with the green transition, right? So those green energy actually is now accounting for 20% of China's energy consumption compares to 15% in 2019. So I think all of that actually helped to alleviate some of the impact from higher oil prices. And I also, would expect that, yes, fiscal policy will actually, be ready, right, to limit, the impact on oil price, crude oil prices, the impact on households.
Aside from that energy security angle, talk to us also about the trade angle, given how the Straits traffic's pretty much halted. Asia's economies, many of them are, reliant on exports.
Yes. I think, at this moment, this kind of global supply shock, right, is going to a big, disruption potentially to the global supply chain, right? So what does that mean, for the global trade for the down the road? I think remains, something that we need to watch very closely. I think the hope at this moment for a lot of people is that this conflict could be rather short-lived, may not last more than a few weeks, right? And in this case, I think the disruption disruption to the global economy, global trade will be rather limited. But I think if the conflicts and also, what happens to the Strait of Hormuz, that actually sustain, more than just a few weeks, then I think that the disruption to global economy and trade could be quite significant.
Tian Wang, great to have you on the show today. Thank you. Tian Wang is Chief Asia Pacific Economist at Vanguard Group. Meantime, Finland's president says Ukraine stands to see some benefits from the conflict in the Middle East, which may hamper Russia's ability to cooperate with Iran. Speaking to Bloomberg in Mumbai, Alexander Stubb also told us power vacuums are allowing local conflicts to spiral into global problems.
Trying to improve your credit scores can feel like a whole workout. Find ways to speed things up on Intuit Credit Karma. See the top credit factors holding you back and the strides you can take to move forward so you can work smarter and hit your credit goals faster. Download the app to get started.
Our golden retriever is 6 years old, but the way she used to act, you would think that she was dying or anything. Switched to a farmer's dog, and her energy levels up because I know she's getting the nutrients she needs. Farmer's dog is human grade for beef, chicken, turkey, vegetable, all that. And it's crafted by a board-certified nutritionist. Starting as low as $2 a day. I always thought it was going to be so expensive, but it really isn't. They've delivered over 1 billion meals since they started. That's billion with the beef.
Jolene and I recommend Farmer's Dog. I promise you won't regret it.
The global problems.
What we're seeing in the world right now is so-called local conflicts becoming regional conflicts, and those regional conflicts having an impact on the world. We see the one, Russia's war of aggression on Ukraine, how it impacted grain or food, fertilizer, energy. Now we're seeing how this war is impacting trade and energy prices. This is what happens when power vacuums emerge and the world order changes. No one exactly knows where we're going.
Can anyone mediate, in fact, given, how White House operates under this new administration? Is there scope for anyone to be able to mediate? Could Europe stand up to that?
Well, I think peace mediation, traditionally, when it's been successful, it's been about the UN and a UN envoy. The previous state visit here to India by a Finnish president was by Martti Ahtisaari, who was a great peace mediator. He was here 30 years ago and received the Nobel Peace Prize in 2008. And he was a firm believer that he needed a mandate. Now there's no one that can give you a mandate to mediate. And I just don't see that happening.
You spoke of the economic costs of war. We're already seeing it in the first order effects and supply chain disruptions, the impact on crude prices, well above 90, briefly yesterday. What else were you counting in as the economic cost of war? Can you elaborate for us?
Well, if you start with the basic, it's just the basic idea of how much does a missile cost or how much does it cost to defend a missile. And here, some of the estimates that I've heard of the first week of the war in Iran is roughly $40 billion.
Yeah, we know that.
And if you then look at the cost of war in Ukraine and Russia, Europe is paying something to the effect of 45 billion this year, 45 billion next year. And if you look at the total expenditure that Europe has given to Ukraine, we're talking somewhere between 250, 300 billion euros. So that, to a certain extent, is the cost of war. But then to start monetizing it in some kind of an Excel sheet, I mean, at the end of the day, the most fundamental question that you can pose is, what is the cost of a human life? In Russia's war of aggression in Ukraine, we're talking about over 1 million dead or wounded. Of course, the loss in the war in Iran is so far much, much smaller. But nevertheless, it's indispensable. You can't put a price tag on it. Then, of course, I know there are a lot of business leaders, so they're looking at things from their business perspective. What is going to be the market impact of this? What's going to be the impact of energy prices? And we don't know. Had someone told me that the cost of COVID is going to be X, Y, and Z, I would have probably doubted it. And I simply don't know where this is going to go.
Finnish President Alexander Stubb there speaking to Bloomberg's Managadoshi in Mumbai. Well, China's foreign minister says 2026 could be a landmark year for ties with the United States. Wang Yi was speaking at a news conference on Sunday, even as US and Israeli strikes continued on China's strategic partner, Iran. Our China correspondent Min Min Lo joins us now from Beijing. And Min, it was a surprisingly buoyant tone from Wang Yi. Is there any indication that we'll see the upcoming leadership summit move ahead?
Yes, Heidi, I think all signals point to that summit likely moving ahead, because one of the first things that Wang Yi said in the press conference is that head of state diplomacy is irreplaceable, and that is a signal that China will likely appreciate the face time with President Trump to iron out all the plethora of issues that they have to work through. Iran was, of course, in focus, but China didn't offer anything more than rhetorical support, although Wang Yi did make a veiled dig at the United States, saying that major countries have to play a constructive role. But when it comes to US-China, as you said, it's surprisingly buoyant, optimistic tone from him, saying that this is a landmark year for sustainable development of ties if both sides remain sincere. And he also said it was heartening to see the two leaders making a good example of holding good interactions at the very high level. He said all that's needed to be done now is to make thorough preparation, to make a conducive atmosphere and environment to manage the differences. So I think this really shows you that China seems unlikely to let the Iran conflict overshadow or knock the US-China relations off course.
Does it also mean, Min, that we can expect some deal-making activity when the two actually meet, if they do meet? What do we know about Boeing being brought into the equation here as well?
Yeah, of course, there's a lot on the agenda, right? And we're hearing from sources that Boeing could be close to a deal to sell 500 next 737 aircrafts to China. And if this comes through, it would be a major breakthrough, because it would end a lengthy drought in Chinese purchases of Boeing aircraft since Trump's first term in power. We understand that there is another deal separately being negotiated as well, a sale of another 100 or so wide-body aircraft, but this could be concluded later and may not be part of that summit between Trump and Xi. But the fate of this company has been very much tied to how the geopolitical winds are blowing, because President Trump has been known to use the plane maker to sweeten trade deals. And of course, this is going to be part of the agenda, and sources have said that it is not finalized. It could be scuttled, especially if talks hit an impasse. Of course, other things on the agenda would be soybean purchases, whether that trade truce would be extended and maintained as it is, and of course those trade restrictions, export caps on H200 chips to China as well.
Thank you, Bloomberg's reporter Min Min Lo in Beijing for us. More ahead on the Asia trade. This is Bloomberg.
What would you tell an entrepreneur who only performs when the deadline is on fire?
That's not poor planning. That's an ADHD brain that runs on panic. Understand it this Monday. Last week, a kid I tutored in high school posted on Facebook, he just made partner at his law firm, bought a vacation home, living the life everyone assumed I would have. I tutored him because he struggled with concepts I understood instantly. Now he's successful. And I'm sitting alone on New Year's Eve, staring at another year wasted, wondering what the hell happened to me. I'm 43 years old, IQ of 134. Teachers called me gifted. Guidance counselors said I'd go far. I've started 6 businesses, finished none. Written 4 novels, abandoned all of them. Had ideas worth millions.
Take a look at Japan futures, and we are seeing all indicators pointing to a pain day when it comes to the Asia risk trade here. Nikkei futures are already down by 2.25%. We're seeing Aussie stocks that are trading really markedly low, with the exception of energy names. We're watching for those energy, LNG related names in the Japan session there, as well as we continue to watch for really the varied impact of the surge in oil prices. It feels like the pretty sanguine approach from market participants at the start of this war has started to wear thin as we get the Strait of Hormuz essentially shut down and that output curve begin to play out. Dollar yen is trading at that 158 level as the dollar continues to be the haven trade of choice. The Japanese government is reportedly considering a release of crude oil from the nation's strategic petroleum reserves as the Middle East crisis deepens. That follows a request from the nation's refiners. Meanwhile, Canadian Prime Minister Mark Carney pledged to expand energy trade with Japan during a visit to Tokyo last week. Let's get more from Shihoko Goto, who is the director of the Asia program at the Foreign Policy Research Institute. Really great to have you with us. So, tell us, in your view, as to what we're watching for in terms of rhetoric from the leadership in Japan. What are the biggest risks at this point, particularly when it comes to that Middle East exposure?
Right. Well, words matter in Japan, and the Japanese government is going to be very careful not to overtly criticize the U.S. attack on Iran. Its focus is to talk about, one, that Japan is against Iran's nuclear ambitions, but at the same time, it wants to promote itself as the upholder of the rule of law. And so there is great unease in Tokyo that the United States has not consulted with its allies and partners, including Japan, and that this is not going to be a situation as it had been in Iraq, for instance, in 2003, where Japan was part of the coalition of the willing and supporting U.S. efforts in the Middle East.
What sort of weight do you think the diplomatic relationship between Japan and the US holds when it comes to potentially having any kind of ability to sway the strategy here, particularly when it comes to implications for the Asia Pacific? We know that any kind of prolonged Middle East distraction would have serious implications strategically, security-wise, for this region.
Absolutely. So Japan actually does not see itself as a middle power. It is proud that it remains the fourth largest economy in the world. It has tremendous clout when it comes to diplomatic weight, and it really does want to be able to use that insofar as it is able to take the lead in getting the coalition of countries to go to the United States and say that what we need now is greater stability and a roadmap for where we can see some ability for the United States as well as Japan to work together to bring peace, to bring security when it comes to energy supplies as well.
Shihoko, this is all interesting for Takaichi, especially given how her words in relation to Taiwan angered China not so long ago. I mean, how exactly do you expect her at this stage to go about articulating her policy of Japan towards Iran, cognizant of, not rattling relations with the U.S.?
Right. So she is, of course, a leader in a vibrant democracy. So she has to address the needs of her people, the voters within Japan, and also address Japan's relations with the United States. Now, on the latter, one of the biggest challenges for her will be when she visits the United States and has that summit meeting with President Trump at the White House. The expectation is that she will make clear that Japan does agree with the United States and indeed the international community that Iran's nuclear ambitions cannot be supported. But at the same time, she will have to walk carefully about talking about the United States actually having to work together with other countries, and we are unclear as to what the end goal of the United States may be when it comes to Iran. But whatever the U.S. goal may be, it will be stronger when it works more closely with Japan and other like-minded countries as well.
Chihoko Goto, Director of the Asia Program at the Foreign Policy Research Institute. We appreciate your time. We'll catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, subscribers can watch live on the terminal using the TV Go function. We do have more data just crossing the Bloomberg after the labour market numbers. This is a trade balance, a trade deficit, I should say, of just over 600 billion yen, swinging from that an estimate of just over 1 trillion yen deficit there as well. So a little bit of a gap there in terms of those expectations. We're seeing an adjusted current account surplus of 3.145 trillion yen as well. We're seeing some pretty hefty expectations of losses as we head towards the start of trading in Tokyo in just about 7 minutes' time. More ahead on the Asia Trade. This is Bloomberg.
Let's take a look at how Asia is shaping up as we see double-digit surges in both Brent and WTI contracts of energy. And this is, of course, hovering near the 110 level. And given these energy shocks, it's really interesting to see how this is coming against the backdrop of last week. Don't forget, on Friday was already a wobbly close on Wall Street. You had some of these concerns about AI investments being pulled back, private credit as well now entering the equation, and this is the setup you're looking at for Asia, where the chip makers are expected to slump at the open. South Korea markets pointing to steep declines, and we're already seeing those declines underway in Australia. We'll watch the open in Japan as well, given how the yen has weakened. That hasn't helped stocks there. This is Bloomberg.
Alloy sink wrench for tight spaces, a set of 2, 7 notches, fits various hose screw sizes, hose screws under sinks and toilets, space is too tight, no room for regular wrenches, plastic wrenches deform, easily remove hose connections, unscrew the white nut too, any place you can imagine, it can be useful, so practical. If your faucet or toilet broke, you pay a lot for repairman. This makes it
This is the Asia Trade. We're counting down to Asia's major market opens. We continue to see really the impact of $100 plus, $110 plus oil reverberate across every corner of this market, Avro. As we get into the start of trading across major Asian markets, we're seeing now the Nasdaq 100 futures picture dropping 2%. These oil spikes, the impact of the elongated war now really having that broad impact.
Yeah, we are in week 2 of the war. Oil price surge is front and center as we've seen both contracts on Brent and WTI on the front end hovering just below the 110 handle, and the concerns about the stagflationary impulse this is going to pose for economies. Heidi.
And pose for central banks, right? And Japan is really front and center in terms of the risks of monetary policy for the Bank of Japan, given the ever now more complicated economic backdrop of more elevated inflation risks. Take a look at how we're going into the start of trading. Futures saw that big drop when it comes to the Nikkei topics. We are seeing losses of almost 2% for both of those markets as we just get online. We'll be watching in particular those energy names, as we've seen those as really one of the scant sectors to see gains, with the Australia session now underway for about an hour. We'll be watching the LNG stocks trading in Japan in this session. We're seeing dollar yen at that 158 level. The dollar remains haven trade of choice at this point. That's also seeing a negative impact on the likes of gold as well. Also watching sovereign bonds, given the big moves that we've seen in Treasury futures as well as Australian bonds so far in the morning session. Switching it out to Korea, because we're also seeing that double whammy of the tech sell-off in the US session overnight, and that's really playing into some of the big Korean heavyweights trading there, including the likes of Samsung in focus today. The Kospi off by close to 7% at this point. The Kosdaq also seeing some pretty hefty losses at this moment as well. Samsung down by 7.8% at the start of this session, April.
Yeah, coming into today, the setup for Asia chip-related stocks wasn't great, following on from the U.S. close, where we did see the likes of Oracle, OpenAI, perhaps pulling back some of those AI-related investments, and then you wrap that together with the private credit concerns. Pile on what we're seeing in energy prices. You are seeing yields continue to inch higher on the 10-year. We are approaching 419 already in Brent and U.S. crude futures. Still, those double-digit gains on the Monday morning and just under the 110 handle. As we said earlier, the concerns about how this is going to feed through into inflation, following on from U.S. jobs data, also pointing to a bit less resilience than previously thought. Don't forget, this week we are also watching out for some of these inflation indicators out of the U.S. Tech is sinking deep. Look at NASDAQ futures, 2% off thereabouts. And amid all this, very interesting to hear from the Trump administration and officials talking about how the fear premium when it comes to oil prices, that is expected to ebb. Take a listen.
We have that oil. We have the world is very well supplied with oil right now. The United States is a net oil exporter. We're a net natural gas exporter. We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. We're communicating with our allies abroad. The oil is there. You're seeing a little bit of fear premium in the marketplace, but the world is not short of oil today or natural gas.
Joining us now is Junbei Liu, who's the co-founder and lead portfolio manager at TanCap. Junbei, always great to see you, particularly at a time of such volatility for these markets. It feels like the period of feeling sanguine about the worst-case scenario for crude has passed. What happens now?
Look, actually, this is what true markets trying to grasp. And what's really interesting is to see different response from both commodities and equities and how what it's saying. What is happening now, essentially, we're just saying how long it will last. Market has already moved on the first impact from the oil, the gold, and others to now second derivative. So we are seeing a lot of stocks like in the consumer, in the housing, especially US focused, all being sold off in a big way. And then we're seeing just in general the risk of people going defensive. Not so much buying a gold company, but going more defensive, and then going back to the safe haven, which is the US dollars, and then some of the, areas where it can seem to be in capital preservation.
I always want to ask you about Australia and China, because I know those are two markets that you're very focused on. Are there opportunities to hide or to sort of idiosyncratic stories in those markets which tend to be less correlated to the global story?
Yeah, actually, that's a really good question. Actually, absolutely. I think in both Australia, China itself is really coming through its own trough a few years ago, in the last few years, and seems that the growth has stabilized, and then recent guidance of the growth numbers seems so pretty okay. So I think China is actually will prove to be more defensive than others, and it doesn't really have a valuation challenge like some of the other markets. And here in Australia, back at home, Australian market is more or less the same. However, we do have the exposure to the commodity market, as 30% of our market, or just a third of our market, is commodity and resources. Now, big parts of it is, across the copper and others. So right now they're being impacted because of potential impact of the oil, that is being impacted somewhat. However, the other parts of the market where our banks and others are somewhat defensive.
Yeah, Junbei, as we speak, we've seen, of course, how the Nikkei has extended those early losses. We are now almost 3.5% down on the Japanese benchmark. I wonder, what do you see as the net effect for Japan at the time where this is also clouding the outlook for the BOJ?
Yeah, look, my view is that, this is going to make it a bit tougher for all of these, markets like Japan, particularly with high oil prices. So, worry about what is going to happen to the global growth. Should the oil remain at the current levels, the global growth will slow down. And Japan being, very export-oriented market is going to be impacted in a meaningful way. I think the BOJ will hold the rates, and and then really we have to see some sort of stabilization in this geopolitical risk.
This year, we opened 2 new restaurants while running, how many?
5 others.
5.
Some sort of stabilization in this geopolitical risk.
Do you see any stabilization? I mean, given how the extension of this conflict has caused a repricing from last Monday to now, just looking at the shock that is delivered to oil markets, I mean, what are the risks that investors at this stage have been underappreciating?
Yeah, that's a really good question because, Monday last week, most of the investors sat here and thinking it will be over within days. But of course, it's proven not to be. But what's interesting at this stage is that, we are not actually seeing oil companies or oil equities or gold equities spiking much. Actually, in fact, if anything, they kind of gone sideways. They got up a little bit initially, but now they've gone sideways and down. So that means that, investors are actually not saying the oil price will stay here, but we are now seeing the second derivative, the sectors, whether it's slowing consumer and others, these companies are being sold off. So what that is saying to us is that investors are taking the risk off the table. So investors trying to stay defensive while we work this through. But investors not necessarily think the oil will stay here, for a prolonged period, because if it does, then we will start really worry about, what might happen in terms of growth and others.
Seeing another painful day when it comes to Korean stocks. Samsung, Hynix really dragging the broader Kospi lower. Nikkei also markedly lower as well, just at the open. Are you seeing opportunities for buying in tech and chips? What do you make of the AI scare trade, which feels like old news now?
Yeah, that's right. It feels like it's so long ago. We start moving on to something else now. But what was interesting, though, in particular, Australian market was seeing much more because we have the growth and then we have the resources, right? So a month ago, it was all selling the growth and buy the resources, and now suddenly in the last few days, you've seen the reversal of it. Look, we think that there is a lot of opportunities in especially the software side of things. However, I think you have to be very selective because right now we're already seeing some of the software companies cutting their workforce in a big way, something up to 50% if you like. So there is, what they're trying to indicate is that yes, there's cost opportunity, but what does that mean to their revenue in the future? So there is a bit of uncertainty. I think at this stage in the market, you want to stay with company has earnings visibility, still have good earnings growth. You want quality of earning, but earnings visibility, pricing power, and some of the software company, the future just look somewhat uncertain. So while there's opportunities, but I think they're still yet to be cheap enough. I think valuations discipline is very important in this market.
Junpei, we're seeing the South Koreans briefly halting their Kospi program trading as futures drop. Is something that has been recurring in the past couple of trading sessions. What to you is an attractive entry point for South Korea chip-related stocks, for example?
I do think Kospi is there's quite a lot of opportunities emerging. But remember, Korean market has always been the beta market where it's very centric with the tech, the oil, the exports, the cyclicals, concentrated with those businesses. So they represent good buying opportunity when we finally have stabilization in oil outlook and also stabilization in the geopolitical outlook, risk outlook. So we need the risk premium to come off before you can step into markets like Korea.
Junpei, always a pleasure chatting with you. Junpei Liu, co-founder and lead portfolio manager at 10Cap here in Sydney. Take a look at the movers, and we are seeing as sort of one of the rare patches of upside in this market of really the Asian oil stocks moving on that $100 plus level when it comes to oil prices. In Japan, we're watching Impex Corporation up by about 2.3% there, and in Australia, we see sustained gains for the likes of Santos, Woodside, as well as some of those other LNG names on watch as well. So much of this, of course, down to what's going on with geopolitics, the continuing war in the Middle East. We're hearing now from Pete Hegseth that President Trump will set the terms of an Iran surrender and there'll be more Iranian boats to be sunk, telling CBS that US strikes on Iran are, quote, only just the beginning. Well, Iran, in the meantime, has chosen the son of Ayatollah Ali Khamenei to become its next supreme leader. Mujtaba Khamenei takes over after US and Israeli strikes killed his father the first time. The Islamic Republic has opted for hereditary succession since the 1979 revolution. Let's bring in Bloomberg editor Mike Heath. Mike, we know what President Trump thinks about him. He said it was an unacceptable choice of a new leader. What do we know about him? Because there's some reports suggesting that he may be even more conservative and harder line than his dad.
Yeah, there's a good profile actually that's come out on Bloomberg that looks at some of these issues. And the one point that you mentioned is that technically there's not supposed to be a hereditary leadership principle there. But yes, he fought in the in the Iran-Iraq war, probably in the late period, just based on his age. And he has fostered very, very strong connections in the security services, in the military, those areas. And it is very much seen as a continuation of the policies of his father. And we've seen that sort of in the defiance from Iran, saying that it can maintain this, this pace of missile and drone attacks for another 6 months, rejecting any suggestions. President Trump saying that they sort of was signaling they were surrendering or something, and rejecting all of that. So it's very much that a defiant Iran that we're seeing, and this sort of seems to solidify that perception.
Defiant Iran, certainly a defiant US, right? Judging from these comments from Pete Hegseth saying that this is just the beginning when it comes to US strikes. How much do we expect this to widen, particularly as Iran seemed almost conciliatory towards its Gulf neighbors for just some of the chaos that has ensued over the past week or so?
Yeah, well, I mean, this is another interesting point that was in this in the profile, is that we had the president of Iran saying, apologising to the neighbours and saying there won't be any more strikes. And then the military just went ahead and continued with the strikes. So whether there's division within the regime, it's very hard to read from so far away. But nonetheless, it doesn't seem like that's going to abate. And if the US is going to widen as well, I mean, we really have to see what they're going to do. But what both sides are trying to do is sort of project this confidence. There's, as it goes on longer, it gets sort of a bit worse for the US and Israel. They need to keep to buck up their supporters, and Iran as well. I mean, it just needs to show. It needs to try to wait out the US and Israel and the West in general, and get that pain threshold from oil, from the attacks on its neighbours, that sort of thing. So it's really, a sort of a contest of wills at the moment.
Mike, on the US front, they seem to be mulling special operations, special forces in Iran to get Iranian uranium. I mean, how much trickier is this to begin with, given the war last year? The uranium went underground. We don't quite know where it is. And how is the US going to avoid mission creep at this stage? Is avoiding boots on the ground becoming a lot harder then?
Yeah, April, you've almost answered your own question there. I mean,
say you have a low credit score and you want a credit card that helps you rebuild credit. Where do you go? Credit Karma. They help you shop for cards, and they show you your approval odds before you apply. Make it simple, y'all. Use Credit Karma.
As a business owner, I've got a lot on my plate. That's why I use ZipRecruiter to hire. The plan was to hire 2 people, but the candidate quality was so good, I wound up hiring 4 in a week. ZipRecruiter.
A question there. I mean, basically, since that bombing in June, I mean, there's been 9 months where there's been no inspectors. Now, Iran used to have very, very intrusive inspection regimes from the IAEA, which have now ceased. And so no one is really quite sure where these, whether this uranium is, enriched uranium is still in the same place. The estimate is that there's about 11 bombs worth of enriched uranium there. But it could have been transferred, it could have been separated into various areas, or kept in a single one. President Trump has said that they'd be prepared to consider special forces on the ground to try and get hold of this. If they could find where it was stored, if it's still in the same place or where it's gone to, that they would be prepared to put in troops on the ground to try and get that, either to dilute it in country or get it out of Iran in general. But as he said, that's not something for the moment, because obviously there's still a lot of strikes going on, etc., and probably they're not really sure where it is. As to mission creep, it's a really interesting question. I mean, when we're talking about, because the basis for the attack sometimes, or the narrative for them seems to change a bit. But when they were talking regime change, really the only way that it just
indicates Japanese equities seeing that decline. I think
it just this contest of wills will continue for a while, because it can break quite quickly. We saw this in Yugoslavia in 1999. It can overnight change, but at the moment it just seems that we're sort of stuck in this status quo for a little while of attacks from both sides.
Bloomberg editor Michael Heath. Well, the status quo when it comes to these markets is firmly in one direction. Japan's Nikkei 225 dropping 5.4%, the most since the April tariff sell-off, and we are seeing now that those losses being extended to about 5.7%. The Kospi also near 6% losses there. Japanese equities seeing that decline as we see oil prices surging towards that $110 level. The escalating conflict in the Middle East. We also saw labour market numbers, the payrolls numbers out of the deal were surprising to the downside. So really stoking concerns about the stability of the labor market there, calling into question what a difficult place that the Fed and some other central banks around the world will find themselves in, including the Bank of Japan, because this elevated inflation picture as a result of exposure to higher crude prices really does confound some more risks for the Bank of Japan on its monetary policy path there as well. So that risk-off sentiment very, very clearly playing out here in Asia. Analysts saying that the volatility, the direction from here is too difficult to read. This is Bloomberg.
I believe that when the two sides treat each other with sincerity and good faith, we will be able to lengthen the list of cooperation and shorten the list of problems.
Chinese Foreign Minister Wang Yi there speaking about relations with the US in his annual media briefing at the National People's Congress. Wang spoke even as the US and Israeli strikes continued on China's strategic partner in a signal that the leadership tends to shield its relationship with Washington from the war in Iran. Our China correspondent Min Lo joins us now from Beijing. So there had been concerns about certainly the awkwardness and tensions as a result of the war, but it seems like it's full steam ahead.
Yeah, it is. I mean, if you listen to Wang Yi's press conference over the weekend, the way he characterizes U.S.-China relations had been surprisingly measured. He said that it was heartening that the two leaders were speaking to one another and really giving a good example of what it's like to hold good interactions at a very high level. He also emphasized that head of state diplomacy is irreplaceable, and that is a strong signal that China will likely appreciate that face-to-face time between President Xi and Trump. And if you think about it, China's relationship with the U.S. carry much higher stakes than its relationship with Iran, right? Because it's an economy, it's going through a prolonged deflation, an economy where consumption sentiment has been weak, and that stable U.S.-China ties could mean less tariffs, less export restrictions on tech, and all of these would be very beneficial for the Chinese economy. In the press conference, he also talked about some of China's foreign policy with other key partners as well, including Japan, and that's where he had very strong words. For example, when it comes to Takaichi's comments on Taiwan, saying that it's hollowed out that whole pacifist constitution that Japan has, and said China will never allow another country to colonize Taiwan again the way that Japan has in the Second World War. He also had very strong words to say about Taiwan as well, warning anyone that opposes China's reunification of the motherland that they shall perish if they do not support China on that stance. And of course, that is the very core of China's core interest. Certainly, it's something that will likely come up as well when President Xi and Trump meet, because we have media reports saying that the Trump administration is reportedly looking to delay the announcement of that $13 billion arms sales to Taiwan in an effort to really smoothen that path for that Trump-Xi summit.
Kibble is the status quo in the industry, and I think it's just because we've been conditioned. I mean, I'm a dog owner too, and I fed kibble for years, and I wish
really smoothen that path for that Trump-Xi summit.
And we are watching out for data out of China as well in the next hour, PPI, CPI. What are we hearing from Chinese officials through the economic
9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching the China Show. I'm Yvonne Mann with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Our top stories today: oil surging above $100 a barrel. Stocks are tumbling on escalating tensions, of course, in the Middle East. A conflict forcing Gulf producers to curb output, divert exports away from the Strait of Hormuz.
A fuel crunch hitting several countries in the region and prompting some to ration supply and take measures to conserve energy.
Also ahead, Iran picks the son of Ayatollah Ali Khamenei as its next supreme leader, while keeping up attacks in other countries across the Persian Gulf.
And China's top diplomat says 2026 could be a landmark year for ties with the U.S., despite their differences over the war in Iran.
welcome to the program. Monday morning, markets are falling out of bed. If you haven't had your coffee just yet, who needs coffee? Just look at the oil price right now. That's going to wake you up substantially. 20% to the upside on West Texas, 20% give or take on Brent. The spread between the two has now effectively disappeared. Also looking at energy prices coming across these screens right now, and that's really leading to risk assets being just taken off the table right now as it pertains to equity markets. We'll get to the dollar story in a moment here. Let's have a look at markets, please, if we can here. So Brent is 107, 108 on West Texas right now. We're coming off highs a little bit as it pertains to those markets. The equity market complex is not doing very well as we speak. In fact, the U.S. futures are coming up on your screens very, very shortly. European futures are also on offer quite substantially too. We'll look at Asia in a moment because Taiwan is coming online. The Nikkei was off 4 or 5%. The Kospi's not doing as well. Dollar is still the preferred haven as it pertains to this broad aversion to risk. Gold is the opposite. In fact, gold is falling right now. And again, the bonds are not acting as a haven right now because it's an inflation pinch. That's the problem. So we're looking at double-digit gains across yield space in Australia right now. U.S. 10-year yield up about 5 basis points. A50 futures coming online. The oil contract in Shanghai is about to show up on your screens. Dollar, China, and the VIX will be very much in focus, and whether or not we will see an anchor coming through in the form of that midpoint today. Shanghai grew 15% to the upside, and we talked about the support level last week. It doesn't seem this will hold for now. The 100-day moving average, we're trading below that on the MSCI All Country Index. Given everything that's taking place, some things get tossed out the window when you have triple digit on oil prices. And that's what we have, of course, as we get started today.
I think we wake up to this reality that we're into the second week of this Iran war, and already you're seeing people price in probably the worst case scenario when it comes to oil prices, right? I didn't really think that we would come back on this Monday morning to see oil at $100, which people were saying were quite elusive. Up until now. So if we've gotten there, certainly it's going to be a time before we just decide how long this conflict is going to last. But it seems like right now oil price traders and really people looking at these markets are not just seeing this as a temporary sort of conflict right now.
Yeah, and at these levels, right, oil becomes a political point of conversation, right? It brings on an FX side of things, will people have to intervene to stabilize current account deficits? Does it become an issue when you go into the midterms for Donald Trump? Does it incentivize the White House to step back because oil is now a political problem, right? And it also has to do with the energy mix of a country and, what you can do in the meantime. Is it floating storage? Do you mix with the energy mix? Lots of components here.
I mean, it's the hit to oil infrastructure. It's also whatever happens to the Strait of Hormuz, as you mentioned. But there's so many other elements here. How much, missiles and drones does Iran still have in its, piles there? So that's going to be one thing to watch. Yeah. So many things to look ahead to. We have a whole team to talk us through all this as well. In the meantime, though, we're talking when it comes to Asia Pacific stocks. We're dropping more than 4% now. So officially, we are entering into that correction territory. Taiwan, we saw those futures were plunging some 7% leading up to the open. And Taiwan seems to be taking us down to that correction territory here in the region. This has purely driven a lot of the moves by the likes of those big heavyweights, TSMC, it's the Samsungs, it's the SK Hynixes that are really kind of weighing on the whole region here this morning. So for more on these developments, let's bring out our team. As I talked about, Steven Sarchimsky leads our Asia energy coverage. Laura Davison is our politics editor. Yanti Tu is also our managing editor for Asia equities. Steven, let's start with you. We're waking up to this reality of $100 oil. What do we do now? What are oil traders thinking about now?
Emphasize again, it is free to join my community. The stocks I share are also free. The techniques and strategies.
Oil. What do we do now? What are oil traders thinking about now?
I think the main thing that the oil market is focusing on is what you've alluded to before. I mean, how long does this last for? Because that's the big unknown here. I think at the last week when this all started, when the strike started, when ships stopped going through Hormuz, people were saying, oh, maybe $100 oil would happen. This is when we were still at $70 for Brent. But the expectation was that this was going to be a short sort of conflict, that this would be resolved relatively quickly. Trump would end this, maybe there would be a taco sort of event, pull out, oil prices would fall again.
Instead of taco event, anybody that puts that in their finals is going to get 20 extra points.
there are real fears that, okay, maybe there is a peace deal, maybe Hormuz does open again, but what about the infrastructure? If there's actual impact on oil tanks, refineries, production facilities, anything like that, and the risk of that continues to grow every day as Iran continues these counterattacks against its neighbors, that raises the risk that this shortage, or rather this output reduction, will continue. And so the market is really, really focused on these, tit for tat attacks and what potentially the Trump administration will do to react. But we saw Trump tweet or post earlier that the $100 oil was a small price to pay for Americans, for the world, for ridding Iran of nuclear weapons, which indicates that he doesn't feel very pressured, at least for now, to step things back, despite the jump up in oil prices.
Stephen, can you talk us through as well, and we've seen the spread close between West Texas and Brent, if you could maybe talk a little bit more about why we're seeing that, and also to your other point, how quickly does this recede? In terms of the news flow over the weekend, right? A lot of the big producers have stopped producing simply because storage is filling up. And I wonder if we do get a quick off-ramp, does that supply then make its way quite quickly back into the oil market, Stephen?
Yeah, no, that's a really good question. Let me focus on that second part of the question first, which is, if you're shutting down production, it isn't easy to bring it back, which is why people weren't shutting it down so quickly. The best thing to do when you have an oil or gas producing asset is to reduce output to as low as possible, keeping it going, keeping the facilities running. If you're a liquefied natural gas plant, keeping the pipes cold, all of that is really key. Once you actually shut in production, if fields are being shut, if wells are being capped, that is not an easy thing to fix. That is something that will take days, weeks, depending on the asset, maybe months if there's damage that needs to be repaired. Maybe they have to do some maintenance on the facility. They have to bring people back. When you restart a facility, sometimes you need special types of people there, special types of equipment that you have to fly in. To restart some of these assets or go through a commissioning period. It is not an easy flip of a switch. These are complicated machines. Now, when you look at the WTI Brent spread, I think one thing to focus on is that global markets, oil markets are global. And there was an expectation, I think, in the market that with oil being so readily available in the United States, that maybe the U.S. would be somewhat insulated. But the fact of the matter is the U.S. is a major producer and exporter of oil, and it's connected to the Brent markets as well. And I think there was some sort of complacency in the market, expecting that the U.S. was going to be able to kind of weather this storm. When in fact, when the Strait of Hormuz is shut, when the Middle East sneezes, it affects the rest of the world.
Maura, it seems like right now we're hearing a bit more about what the succession looks like here. The son of the late Ayatollah Khamenei is the new supreme leader. What do we know about them? Could we call this some sort of regime change or not?
Highly unlikely that at least Trump is going to consider this a regime change. The son is someone who he was actually asked about publicly several days ago, said that he would be unacceptable as a leader. The 56-year-old son is largely seen as an institutionalist, someone who, he's not been in the public eye much, but close to his father and close to sort of the military and all of the institutions that be in Iran. So unlikely we're going to see a huge vibe shift there from the president, from the new supreme leader of Iran, which suggests that Trump is not going to be able to frame this in any way, shape, or form as a win. We're kind of in the point where you see different top officials in the U.S. sort of trying out different rhetoric to see if they can maybe kind of get some sort of mission accomplished off-ramp here. And so far, they've been unable to land anything, partially just because, they haven't had any success that they're really able to tout, minus dropping some bombs and sinking some ships.
Yeah, I think there was an earlier report separately, I think along the same lines, that it would be up to the U.S. president to determine the terms of surrender of Iran. Are things about to get worse before they get better, or have we passed that peak? Is there any information we have right now to make that determination?
It's highly unclear. One thing, though, that everyone should be watching really closely is this possibility, story on the terminal from our colleagues across the globe, that the U.S. is looking at a potential special forces operation within the country. This would go after the enriched uranium supplies. That really suggests that the U.S. at least is thinking about or worried that they're not able to do what they need to do via an air campaign. Ground forces has really been that red line. Caroline Leavitt, the White House press secretary, recently and yesterday, yesterday said that ground forces were not part of this. Sending in troops on the ground, it's much more risky. The chance for casualties increases significantly. It also raises the question too of what's the strategy after some sort of special operation. If it's successful, is the U.S. then able to declare victory and say, okay, we're out? If it's not successful, then what's the plan? Or does Trump continue on this path of regime change and still sending in to try to destroy uranium supplies doesn't address leadership at all in the country?
All right, Laura, that was obviously what we're hearing in terms of on the ground and really the politics around all this as well. Let's talk about the markets and what we're seeing, right? We talked about, when it comes to the regional stocks already entered into that correction. Taiwan is also heading that direction here right now. Let's bring in Van Tang, looking at how things are going here right now. Van Tang, talk us through this price action right now.
Get tax expertise without hidden fees. Switch to a TurboTax expert for $150. All tax situations, all returns. $150 all in. No surprises. Now this is taxes.
Hey, Ryan Reynolds here from Mint Mobile. I first ditched big wireless and started using Mint Mobile way back in 2019. Back then, you could get premium wireless for only $15 a month. Today, Mint Mobile's premium wireless has gone up by, wow, that's it, zero. That's gone up $0 a month since 2019. That doesn't seem fiscally responsible to me, but again, you're welcome. And I'm not an accountant. Hate math, always hated math. True story, I was in math 10A when I was in 12th grade.
Yeah, I think as the guests already mentioned, it's just this really big recalibration that's going on among investors, that this war may really be here for the long run, just because of the weekend news flow. Trump is talking about expanding attacks instead of winding down the attacks, and also the appointment of the new supreme leader in Iran. So people are now game planning the worst case scenario, and they're selling stocks indiscriminately, and especially those big large cap stocks. So, the big chip makers in Korea and in Taiwan, and especially in Taiwan, we're seeing the worst or the biggest outflows out of Taiwan last week. That means people are really locking in the winners that we saw this year so far. And also for Asia as a whole, Monday morning low liquidity, that exacerbates all the movements. But also Asia is a region that is most vulnerable to any shutdown for the Strait of Hormuz, because Asia gets more than 70% of LNG and oil from that Middle Eastern region. So with this kind of shutdown, now we're seeing news outflow out of Korea that the country is looking at oil price cap. And this morning in Taiwan, we see similar news. That's really sending the signal to investors that inflation will soon become a really big issue for Asia economies, if not for the world. And that means Asia central bankers are really having their hands tied.
I'm just looking at futures right now. While down, it doesn't seem that, well, it's early, but it doesn't seem like China is going to see the brunt of the selling, at least to the magnitude we're seeing elsewhere in the region. Anything specific that your team is watching as we approach the China Open today?
Yeah, I think China is now considered to be a relative haven. Morgan Stanley mentioned how China is a big winner out of this energy crisis because China can get oil from Russia and Venezuela and Iran. All the global South trends seem to be coming in handy right now. I think people are still sort of recalibrating what is the takeaway from the MPC. And so far, it seems while there is no huge surprise, relatively speaking, China is better positioned just because Chinese shares were sold off a lot more. If you look at HS Tech, it was down 30% from October peak. So there is not a lot more to sell. And also overall tone from the government is positive. We're talking about tech. We're talking about a robot. We're talking about a little bit of a consumption and property support. So just in relative terms, China all of a sudden looks a bit better.
Stephen, I want to bring you back in. It seems like a lot of the pain that we're seeing is really focused on oil markets. It's focused on LNG. Is there a threat or a risk that this could spread to other energy commodities? We take a look at electricity. We take a look at coal right now. Are we seeing any of that?
Yeah, I mean, yeah, it's all connected. So yeah, there is a lot of focus on oil and LNG, but when natural gas prices rise, coal prices rise. So we've already seen a jump in coal prices exported from Australia. Obviously, not affected by what's happening in the Strait of Hormuz, but they're up to the highest level in years. We're also seeing an impact on electricity prices. Now, Japanese power futures, that's not the price that people pay in their utility bills, but it's the price that utilities pay to hedge their power production and procurement. Power prices in Japan are rising pretty significantly. We've seen a jump over the last week of 20-30% for front month futures for that contract. We're seeing LPG prices, which are used for cooking in South Asia, that rising as well. And we're seeing gas supply being curtailed to fertilizer plants, which risks increasing the price of fertilizer, urea, or anything that's used for food production for farms. So this does have a wide impact. All energy markets are interconnected.
Stephen Sapchinsky, thank you so much. Laura Davison just now as well, lending to our team, of course. We're covering all angles to the story here as pertains to these markets. You're just in time in terms of the midpoint out of the PBOC today, 691.58. This is important because Asian FX is really on offer right now. In fact, the dollar is now up for the year with the move we've seen since Friday, give or take. We're now looking at substantial weakness coming across the Asian FX complex. And just on top of that as well, it's also worth pointing out that going into the open today, we'll be looking at inflation coming out of China, which is quite topical given, of course, where the markets think inflation will be moving forward given the spike in energy prices.
Yeah, this may be the one of few sort of economy that actually would welcome possibly the surge in oil prices here right now. But as you see, right, the dollar is clearly the winner here. Oil and dollar probably are the clear sort of moves that you're seeing to the upside. You are seeing substantial losses here when it comes to EMFX. In fact, when you take a look at the Philippine peso, we're at a record low here right now. So we continue to see pronounced appreciation pressures when it comes to Asian currencies here this morning. In terms of your agenda as well, of course, we have to focus on not just the stock route, the impact of the renminbi as well. You know, we're still dealing with the two sessions, right? That actually kind of still is going on this week as well. Although the market has seemed to have moved on too in some ways. Volatility certainly is going to be the big name of the game here today when it comes to what we're seeing in Japan. We'll see if the Hang Seng sees that pop as well. We're watching those key sort of technical factors here. So 200-day moving average for the HSI, that's going to be a key focus whether we break it or not. And of course, we're still looking for some inflation data out of China today.
Yep, that's coming out in about 13 minutes from now. Sectors to watch for very obvious reasons. Oil, gas, precious metals might go the opposite way given, of course, how gold has been behaving as far as prices concerned. Shipping and logistics, it has everything to do with transport, everything from shipping. I'd even toss in airlines there. Financials might act as a buffer. It's might, and of course, CATL, if it matters on a day like today, is coming out with earnings as well. On a day like today, I mentioned that. Here's what you got as far as the damage control or the damage is concerned across these markets. We're off 3-4%, 4% now on the benchmark. We are set to enter a technical correction this early in the week. The opening bell 11 minutes away, counting down there. Shanghai, Shenzhen, and here in Hong Kong. This is the China Show.
Trying to improve your credit scores can feel like a whole workout. Find ways to speed things up on Intuit Credit Karma. See the top credit factors holding you back and the strides you can take to move forward so you can work smarter and hit your credit goals faster. Download the app to get started.
Looking to hire? Medical staff, tech support, kitchen help, freight managers, you name it. ZipRecruiter delivers candidates with the right skills and experience fast. So fast that 4 out of 5 employers who post on ZipRecruiter get a quality candidate on day one. ZipRecruiter uses powerful matching technology to find.
Right. Welcome back. We're looking at these markets and we're giving it some time to really get warmed up. We'll need every warm-up we can get. More, not just a case of tendonitis that goes away with a warm-up effect. There we go. So we're now down 2.7% in the pre-markets in Hong Kong, and as you can see, it's really playing out across these markets. The PBOC weakening the VIX as well by the most since November 2024 rather, and that really is down to just a big move up in the US dollar too.
Yeah, that seems to be the haven of choice right now. You're not seeing that go to bonds. You're not seeing that go to gold, which is quite as given just the run-up I guess we've seen in bullion. So certainly that is the clear expression that we're seeing across these markets here is the dollar, and of course that spike in oil prices here today. We did hear from Kevin Hassett, the White House National Economic Council Director, and he says that he's confident the surge in oil prices will be addressed in the near term. He's told Bloomberg that the Trump administration has many tools available to tackle the increase in energy costs.
We know that sometime soon we're going to have a much more stable Venezuela with high stable energy output, a much more stable Iran with high and stable energy output, which is going to be very good not only for energy markets but for risk premia around the world. Don't forget that this move against Iran is happening because they promised to destroy us all. Like if that's not something that affects risk premia, I don't know what is. And so I think with an eye on the horizon, then you can see that this is a huge positive for the global economy and global markets. The question is, when will the current near-term disruption end? And that's something that'll be decided by the military. And of course, will be some uncertainty about when they decide to move, in part because the uncertainty protects the lives of American soldiers.
Kevin, in the meantime,
but we expect that it'll be resolved, quite soon.
As you see, we're starting to see a hit to production. Because we can't move the oil, we're breaching storage capacity in select producers right now. You saw some of that with Iraq earlier this week. The journal reporting months ago, we're seeing the same thing in Kuwait, and UAE and Saudi Arabia might follow. That's obviously a bigger, more acute issue for the Asian refiners right now, which is why the Treasury Secretary came out and issued a waiver for the Indians to buy from Russia, the Russian crude that's offshore in tankers right now. But Kevin, I wonder what else the White House has got in store. Not just to tell people to wait, because in the future it'll be better, but what are the remedies that you could produce right now?
Oh, sure. The sanction waiver that Secretary Bessent came out with is just one of many, many tools that we have ready. We've got a whole flow chart of tools to use depending on this or that, and we're ready to move them as soon as we have to, but we're also very optimistic that we're going to be able to get this near-term problem resolved relatively quickly.
The Biden administration, as you know, burned through the SPR, took it down quite dramatically. Is there space left in the SPR to deploy some of that to bring down prices just a bit for consumers?
There is no conversation right now to dip into that, but we've got something like 400 million barrels ready to go if needed. But there is, I re-emphasize that there has not been a conversation to dip into that yet, because our expectation is that this effort in Iran is way ahead of schedule, and that we understand that there are near-term market fluctuations, but we have our eyes on the horizon, and we think that's where people should be looking to.
Kevin, you say ahead of schedule. Is there a schedule?
Yes, but obviously we're not going to go through the schedule on TV.
Right. If you're long Hong Kong markets, close your eyes now. Full preview. We are poised to open substantially lower this Monday. This is Bloomberg.
Good morning, my love. Yo, where you been at? I've been here a few days. I haven't seen you.
Everything but oil. Everything but oil
Oh,
today.
so you got the bomb schedule. Okay, I think.
Down now 5% this Monday.
Yep,
Nice.
everything but oil, as Dave mentioned. Look at HSI movers here this morning. It is really the energy space that it continues to see upside here. You see CNOOC is up some 8% here in the pre-market. We got the open coming up next. This is Bloomberg.
All right. Brace yourself if you haven't buckled up already. We're looking at steep losses going into the open today. And we're actually on
better footing in Greater China compared to what we're seeing elsewhere across the region, where we're down 4 to 6% across the other major benchmarks. On Asia, we're down about 5% on the benchmark itself going into this open today.
Yeah, as Lindsay mentioned, maybe because just its overall positioning, right? Where China was already kind of in some ways on the weaker side of things, maybe that's why we're not seeing as much impact as the Koreas, as the Taiwans are here today, and then reacting to, of course, this reality of $100 oil right now. We've entered into week 2, of course, of this Iran situation, and it doesn't seem like there is any sort of easing in sight. So that's why you are seeing oil traders continue to start to react that this might be more than just a temporary sort of blip, that we are pricing in more of a prolonged scenario. And that's why you're seeing the dollar pop, oil pop as well. Everything else in terms of risk assets are on offer here today. CSI 300, there you go. As we open the gates here, we're lower by about a 1.3% here. Shanghai Composite, we're getting close to that 4,000 level once again here. But bonds are not really kind of reacting, right? Even CGBs, we are seeing yields actually tick up on the long end here this morning of the 30-year. And we're watching, of course, Shanghai crude. We're up some 17% when it comes to Shanghai futures for oil here. So really kind of not just kind of reflecting what we're seeing in Brent markets here, but in fact, the moves that we've seen of late have also been even more in terms of magnitude. But right now we are seeing, of course, still reflecting that 20% pop initially that we saw in Brent prices here. And are we starting to price in sort of the worst case scenario when it comes to oil markets? Because we talk about it's not just the impact on Strait of Hormuz, and whether we do see it effectively shut right now. We talked about some of these Iran links, some of these China vessels are still able to get through. So the China aspect of this is quite interesting as well. But also the damage to oil infrastructure when you have the likes of UAE, when you have the likes of Kuwait, also now halting oil production in quite a substantial way, and following what we saw with Iraq already. So the question today is, will other nations around OPEC Plus continue here? So that's really one thing. Most large caps are lower here. The chip space, where Capricorn Tech is down to 3. So tech certainly is selling off here today in a big way. But as we mentioned, right, it's everything but oil that is indiscriminately selling off here. Let's look at Hong Kong as we talk about here. Now we talk about, Asian stocks already are in some entering to a technical correction. Taiwan also has done that. If we continue, of course, with these losses here, Hang Seng is down some 3%. Asia's Tech, we're down about 3% as well. So it really is that some single narrative right now that we're seeing here. The weakness in the renminbi is quite prominent. We did see one of the weakest fixings since November of 2024 from the PBOC. We're at 693 levels here this morning. So that flock to the dollar continues here today, and really you're seeing everything get swept away alongside with it. And we said, right, it's the energy space, right? When you take a look at LNG, when you take a look at crude, that's where kind of that pain trade continues to be here right now, or at least the one direction right now. But think about what this has, the impact on electricity, what it has on coal, especially here in China. So certainly that's one thing to watch. Let's look at some of these energy shares that we're seeing. They are the clear sort of bright spot here across a sea of red, and it's the CNOOCs, the PetroChinas, that were up some 8% in the pre-market here right now. We are also seeing now with the Kospi triggering a circuit breaker. So Dave, some more pain falling through in Seoul this morning.
Yeah, okay, so we just hit, in fact, that 8% threshold, Yvonne, on Korea. I mean, you're talking about how this is really just about across the board right now. In fact, that's going to come up on your screens right now. Taiwan came online just this hour as well. We're down 5.5% on that specific benchmark. As you can see, Korea is now 8%. We'll need to wait a few more minutes, of course, before that gets up and running yet again. That's been quite common, in fact, the last couple of days, as the market has really just also obviously taken off some of the froth that's been built up given the rally. We talked about the Hang Seng Index. Let's flip the page, please. Have a look at all benchmarks right now. V Kospi is going to be very much in focus, and really this dynamic between where's the haven showing up, it's showing up in the dollar, and as you can see, not so much in the gold price. We're up substantially in terms of expected vol on many of these benchmarks. And in case you're just headed to bed in the US or in Europe, why you're still up, as you look towards your Monday, it's not looking pretty. As you can see on the screens, futures are pointing to substantial downside over the next 24 hours at least, or I mean, we'll see. We're very headline
risk in terms of dynamics right here. Speaking of headline risk and breaking numbers coming through, we have inflation numbers coming through. Decent ones as well, actually.
Actually, pretty decent, Dave. Right? And we were expecting a little better print here when it comes to CPI prices. So 1.3% higher when it comes to CPI for China in February here. So that is beating estimates. There is that Lunar New Year effect here. So maybe there's some demand and base effects to deal with from the timing of the holiday as well. But we take a look at some of these high frequency indicators, did suggest that when it came to holiday demand, that's what drove food prices higher. We talk about year-on-year gains in vegetable and fruit prices. That actually ramped up there in the first 3 weeks of February already. Factory gate deflation at least narrowing as well. We do see print now at negative 0.9%. The estimate was for a negative print of 1.1%. So, what has been supporting that seems to be commodity prices, right, which have been firmer, which have been led by oil as well. So that's why you are seeing, when it comes to PPI, still in negative territory, but less so, Dave.
Yeah, okay. I need to take a breath.
Don't we all?
Yeah, 35 minutes into the weekend. Kind of really need the next Monday to really come. I need the weekend. Okay, let's have a look at if there is some level of visibility across the markets short term. And longer term, really, is this a buying opportunity that people have been waiting for? Do you buy this dip? Let's bring on our next guest. Sylvia Chang is a global multi-asset strategist at JP Morgan Asset Management. Is here with us on this quite eventful Monday morning. Very nice to see. How are you thinking about markets now?
So I think if we look at what's happening today, clearly the market is repricing a more prolonged conflict in the Middle East. And what we're seeing across Asia market clearly is a de-risking event happening. I guess for us, when we look at this, I still think it's too early to assess what's actually going to happen in terms of oil prices, whether we're likely to see the persistence of oil price shocks. I think that's really the key here. Because if we look at historically, when we look at geopolitical events, they tend not to have a lasting impact on markets unless they have that sustained impact on macro fundamentals, especially oil prices. I think that's really what we're looking at right now.
What's your base case now, how long this lasts? Is it weeks? Is it months?
I think it's very difficult to talk about a base case right now, just given how fluid the situation is. But I think compared to last week, this is definitely longer than what people have been pricing in. And I think what happened in the market is because we had the flare-ups in 24, 25, and oil prices failed to sustain any rallies then. So I think investors, their initial reaction is to fade any of this kind of geopolitical volatility in the Middle East. But clearly, if this is wrong and this lasts much longer, we could see the sharper reaction to this just because how the investors are positioned.
I wonder if you have any insights why the dollar is suddenly the preferred haven asset and not gold, or is that just positioning going into what happened?
I think positioning definitely plays a quite important role here. And if we think about the dollar, actually, we have the view as well, more on a structural basis. Dollar is overvalued, and we see that stronger fiscal stimulus elsewhere, creating a more balanced global growth. So U.S.'s kind of growth advantage is fading, monetary policy divergence where Fed is cutting, ECB is holding, BOJ is hiking. All of that point to a weaker dollar. I think people are positioned that way. Clearly, in this round, the safe haven bid will push up the dollar.
So you're still maintaining this pro-risk sort of tilt. Have you done anything the last week to kind of change up your holdings? And where you're tilting towards to now?
Right. So last week, no, we haven't really made any changes. So our position in our multi-asset portfolios is really based on fundamentals. If you look at the global economy, it's still running at a pretty solid pace. If you look at PMIs that came out last week, still pointing to a pretty strong global growth picture. So that's still underpinning our pro-risk tilt here. And from a U.S. kind of economy perspective, we still feel the recession risk relatively limited right now, like 15% recession risk looking at the next 12 months. Clearly, that's not considering what potentially could happen with the oil price. And for us, we were just monitoring the situation last week. We don't think it was a great idea to really go into kind of any portfolio changes given the volatilities we're looking at.
It's obviously very difficult to time the bottom in the market. But for people who are tempted to buy this dip or at some point get in and deploy some cash, what looks attractive right now?
I think if we look at the markets right now, clearly we see kind of Asia selling off a bit more compared to other markets, at least so far. US is a bit more contained, but I do think we need to put that into context of how oil prices affecting the fundamentals of the different economies. Asia as a whole is likely to experience more negative terms of trade shock. If we look at a 10% increase in oil prices, Asia's current account deficit is likely to widen by 30 basis points. So it is to some extent reflecting that fundamental that Asia is likely to be hit harder because they're oil importers mostly here, and US clearly has that big oil and energy sector that is likely to benefit. I think to some extent it's reflecting that, but we do need to get a bit more clarity of how persistent that oil shock is likely to be.
It seems like we've been, analysts talk about the impact on Asia. Certainly, that's one thing. Europe certainly would take a big hit from all this. I know you have a very contrarian call on Europe this year. What's sort of the case you're building around Europe?
Right. So it's more fundamental. If we look at soft data, clearly turning PMI is getting better. And we do think we're starting to see that impact of fiscal stimulus coming through in Germany. So that's really one where we do think supports that growth recovery story in Europe. But Europe does have that weakness where it's very exposed to energy prices, especially natural gas. So that could definitely be a catalyst that would kind of dial down our optimism on Europe.
Okay, Sylvia, thank you. Sylvia Shane there, Global Multi-Asset Strategist at JP Morgan Asset Management. So we are looking when it comes to bonds in particular here today, right? So when you look across the curve here, you are continuing to see that melt up in yields. Look at the Aussie 10-year yield. We're up some 13.5 basis points here right now. So certainly there is that possibility for pricing in what central banks are going to have to do, given that inflation expectations are now continuing to rise with the price of oil here. So we're at 4.18. We're getting close to 4.2 levels for the U.S. 10-year yield as well, Dave.
Yeah, I think it's May now that's fully priced for the next move coming out of the RBA, which is to the upside. I think when you look at the dynamic pricing around Europe, a full hike is now priced for October. The BOG, of course, is a separate conversation because we've been expecting hikes there anyway. The Bank of Canada is interesting. Not a full hike just yet, but we're effectively base case now based on the current pricing. This changes, of course, by the minute. About 70% chances of a rate hike in December. Right, lots more ahead. This is Bloomberg.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Right, welcome back. The move you see on your screens, that's not a week to date, a month to date, a quarter to date, year to date, that's today. Oil prices are up 20% at the open, massive gap higher given events over the weekends. Energy buyers across the region are feeling the impact of the supply crunch due to, of course, what's taking place, disruptions being priced, freight costs. Yeah, let's bring in our oil trading reporter for the Asia Pacific. Wong Wei Niao is with us out of Singapore, and I'm sure your team has been extremely busy this morning. Take us through what conversations you're having amongst yourselves and with the people you speak to in the market, Wong Wei.
All right, so of course, oil hit a milestone like you pointed out earlier. Oil is above $110 right now. I wouldn't say this is unexpected. Towards the end of last week, when prices kind of softened on the back of a lot of assurance coming out from the U.S. Trump administration, such as providing assurances for ships going through the Strait of Hormuz, as well as Trump's latest move to allow India to purchase Russian crude barrels to alleviate the supply crunch. But over the weekend, of course, we saw many more attacks happen, which resulted in several Middle Eastern oil producers cutting back on production. So naturally, when the markets open today, we would have expected to see a spike. But of course, this level of magnitude still took us by surprise.
Walk us through what some of these Asian economies are doing here right now. Obviously, these are big importers of Iranian oil. In terms of rationing supplies, conserving energy, what are they doing now?
All right, so actually the main impact on Asian buyers is more on the fact that a lot of these economies are highly reliant on Middle Eastern oil. And of course, the cascading effect is naturally it also led to a surge in a lot of these oil product prices, such as jet, diesel. We have seen all those skyrocket in the past week. So for a lot of Asian buyers, which are highly reliant on these resources coming out from the Middle East or via the Strait of Hormuz, we have been seeing quite a number of these refineries or petrochemical crackers. They have been cutting production. They have been sending out notices to customers to say, hey, we're not getting our feedstock supply. So unfortunately, we will have to deliver fewer cargoes to you guys. And of course, what we have noticed in within Asia as well, because it's such a huge continent, is perhaps the more affluent countries can actually afford to bid higher for these cargoes, which leave the countries that are less affluent to be sort of bearing the brunt of these all these supply crunches.
Ronway, thank you, Ronway. You're there. I'm sure your team has been busy throughout today. So we're watching very closely what goes on when it comes to the Asia impact. Also, when it comes to these markets, right? Because you're starting to see more policymakers, officials are talking about things to stabilize these markets. Taiwan is the latest now. We're hearing that the Stabilization Fund may convene today to have a meeting on these markets. We've already heard from the Bank of Korea as well this morning.
Yeah, the headline on Korea crossing about 15 minutes back that the BOK specifically is looking maybe at a meeting to discuss the impact on that too. And that also goes into, so everyone from monetary officials are looking at their current accounts, and if they're staring at something of a large deficit there, that obviously is a currency conversation that they need to be having. Equity markets, of course, is something different, of course, in terms of stabilizing that. And separate to that, of course, you have energy officials looking at this. And, we mentioned Korea, right? Korea last week, conversations around potential price caps, right? It's a conversation. We need to talk about China, for example, and the conversation there around limiting the exports of crude products because of just how fluid the situation is at the moment.
Yeah, for more on oil markets, let's bring in our Bloomberg intelligence analyst, Henrik Fong. He joins us here in the studios. Henrik, it's great to have you on the program. Are you surprised this morning that we woke up to $100 oil?
Yes, a bit. I think there is a sharp shift in view in the market. So at the very beginning of this tension, basically many will expect this is maybe like a small scale restricted war. But now, as we move into this situation, I think the view is changing. So the concern on oil supply disruption is deepening. So getting $100, I think it is within expectation.
It's quite a surprise. In fact, we're not just at 100. Brent just crossed 112 quite literally a few seconds ago. How do we need to be thinking about, or countries need to be thinking about their energy security right now?
Well, there are a couple of ways that countries can, deal with the situation, but more or less, I think they will, suffer at the end of the day. So, for example, here in Asia, they rely heavily on Middle East crude import, and Japan, South Korea, China, and I think China is in a relatively better position than the rest of Asia. The reason for that is because China doesn't only rely on, seaborne oil. They have pipe connecting to Russia. They can get Russian pipe crude. They can also use the Northern Sea route to import LNG and also crude. So, and also China is sitting on a huge strategic petroleum reserves.
Okay.
So if they follow the OECD guidance, I think they don't have to, but if they follow, they are now sitting on more than 1 billion barrels of oil reserves. So that would be more than enough. I mean, taking into account all these measures they have done, they would be okay for the next 8 to 10 months.
So China might be better positioned. How are you looking at the rest of the region? Who's the most vulnerable right now?
I think Japan, South Korea, and also India. India, as you know, that they are already trying to get permit from the US to import the Russian crude, right? So, particularly for, Japan and also South Korea, they don't have any other, ways to import crude except through tankers. So I think they may be more vulnerable than the rest of Asia.
Are we missing any other aspect that you think markets should be paying attention to? So we know about potential disruptions. We know freight costs, not freight costs. We know shipping costs are going up as well. What else do we need to be watching?
I think right now the focus is definitely on high oil price, supply disruption, inflation, right?
Yeah.
But I think the next step we should be looking at is more on demand destruction, because if we look back to the history, every time when oil spending as a percentage of the world's GDP growth, it hit like over 12%. It start to come down because of demand destruction. So I'm not saying that this time they will reverse when we hit 12%. It's now 10.5% roughly. But definitely there is a possibility there.
Snap your W-2 and file your taxes 100% free. Plus, get your biggest refund. Roughly 37% of filers qualify. Simple Form 1040 returns only. No schedules except for earned income tax credit, child tax credit, and student loan interest.
A possibility there.
We too have already reached $110 for oil. Yeah. I mean, how are you looking at your models right now? Where do you think oil prices can go from here on forward?
Okay. I think based on history, like for $1 risk premium, they will push us to 100. Right now is already 110, right? So I think if we use another model like oil spending, 12.5% will be roughly like $133 at this moment. So, I'm not saying that at one moment we will reach 133, but for the full year, if we have to reach 133, that will, take us, pick the bottom, maybe 150, 160. That's possible. Depends on how the situation would be.
Yeah. At 133, we've effectively doubled, right?
Yes.
Okay. We know you're going to be very busy today. We'll let you go, and we hope if we need you at some point, we'll give you a call and we'll see you back here. Henny, fantastic. Thank you so much. Grateful for the time. Henny Fung there, of course, our Bloomberg Intelligence senior analyst for energy. Guess what? West Texas is now up 25% today. We've now taken up 113.40 on the most active contract there on New York crude. Lots far ahead. This is Bloomberg. All right, welcome back. An update. Let's start things off with Korea. So circuit breaker was triggered 20 minutes back. Quite frankly, if you ask me, it's probably a good time to not be open right now, given the price action right now. Anyway, the market resumed trading, and we're now down 8.1, which really is academic, between 7.5 to 8.1. But yeah, something we'll track, but that is really just underscores the price action today.
And just, we'll see what the retail investors are doing, because up until last week, they were actually net buyers of Korean shares. Take a look at how these ETFs were performing as well. So, it's really dependent on what, mom and pop investors are going to be doing there in Korea, just given that, foreign investors have in some ways been selling off in the last couple of sessions. So that definitely gives a more risk to this sort of market here. But right now, we're still seeing, of course, those 8% losses for Korea extending further and really deepening the sell-off there. In terms of other sort of movers you're watching out for, given just the oil price spikes that we've seen, the clear loser has been, of course, the airlines as well. Take a look at Qantas, take a look at Cathay Pacific. We're seeing losses of 5 to 6% here this morning. It seems like it is the airlines, chips, and really just sort of the whole AI sort of play. You got to kind of toss that to the side here right now, because it seems like the headlines around Iran is overpowering even the AI trade here. You take a look at how some of these, even the national sort of champions in China are doing. Capricorn Tech, for example, is down close to 5%.
Yeah, it's not a good day to long these markets. Silver lining is when you get dislocations like this, they tend not to last very long. But we'll see. This is a very fluid story. Lots more ahead, of course, on the Middle East conversation. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI half hour in the session. I hope you had a good rested weekend, because we are dealing with quite a bit of volatility here on this manic Monday, just given that we woke up to the reality of oil prices now well above $110 here. This, as we continue to see oil traders, the shift that we saw in the narrative, right? I think last week some were saying, look, this could maybe not last too long. Now I think things have changed. People are now pricing in even a prolonged conflict and what that may look like.
Yeah, I mean, it tends to spook most everyone, including a producer, right? Because oil with three digits is a politically untenable. It starts to eat into demands. You can't produce as much that people are willing to buy. In fact, I think last week, our colleague Linda had this really good conversation with the Bangko Central governor, the BSP governor of the Philippine Central Bank here. He talked about $100, the threshold. So it's really ticking a lot of boxes that will tick markets off. And that's exactly the sorry state of markets you're looking at currently because of what's taking place there, right? So, who would have thought we'd be writing a headline, stocks down 5%. We're looking at West Texas up 25%. That's exactly what we're seeing today in these markets.
Yeah, capitulation, I think, is the word as we continue to see this sell-off deepen across the Asia Pacific, as we talk about, right? It's really that haven demand to dollar. Is the oil price where we continue to see to really kind of spike, right? And all the traditional havens that we've been talking about, whether it's bond markets, whether it's even gold, are not behaving the way that they should. And the dollar is basically comes out as a very interesting and I guess complex sort of winner in all this as well, this fight to safety. So there you go. You see S&P futures, Euro futures are doing this here right now. So yes, that Monday morning, I know the clocks have changed, but yes, they're waking up a little bit earlier here to really see this pretty painful start to the week here as we enter into a second week of this Iran conflict. And EMFX, as Dave has mentioned, falling out of bed here this morning as well.
Okay, an update of Brent. We touched 113 a few minutes back. I think that's where we're trading still. In fact, now West Texas is now trading more. There's a premium now on U.S. crude over where you are on the international contract. Shanghai crude, of course, plus freight. We're up 17%. Gold, as Yvonne was pointing out, of course, not acting currently as a haven place. That also falling out of bed, which I think is also worth pointing out to the downside. Across the futures curve, a lot of the gains are being seen on the front end of the curve. And really, when you look at stocks, we thought it was going to hold that 100-day moving average last week. But the assumption was perhaps not that oil was at 100, where we are right now. So currently, MSCI Oil Country Index, the start of the week, has now taken out to the downside this key support level at a 100-day moving average. So it has faltered for now. The chart is coming up on your screen very, very short.
Yeah, we talked about Asian stocks in the region already, technically entered that correction. Taiwan certainly dragged that, is in that similar territory here when it comes to correction in Taiwan, the TAIEX. Now we're getting another headline with Indonesia markets opening up. The rupiah is now at a record low. Stocks also in Jakarta set to enter a bear market. So we're talking about 20% losses from the top that we saw just recently. So certainly there's going to be a lot of ongoing EMFX sort of pain across this region, given the fact that a lot of these economies are, of course, oil importers from the Middle East as well. Let's bring in our team here. Ruth Carson is Bloomberg's chief correspondent for FX and rates in Asia. Let's talk a little bit more about just overall the winner is still a clear favorite, which is the dollar.
Alloy sink wrench for tight spaces, a set of 2 to 7 notches, fits various Bose screw sizes, Bose screws under sinks and toilets, space is too tight, no room for regular wrenches, plastic wrenches to form, easily remove hose connections, unscrew the white nut too, any place you can imagine, it can be useful, so practical. If you're lost.
Overall, the winner is still a clear favorite, which is the dollar, Ruth.
Absolutely. There's a reason why it is king dollar. It's getting a bid on all sides, from those looking for the haven, the ultimate haven trade. And there's also the fact that, the dollar is linked to the US. They are a huge oil exporter. So there's the petrodollar story really fueling that bid as well. But what's interesting is the fact that none of the other havens, perceived havens, are actually working as a haven. It is pure dollar playing here. Investors, whether you are in Sydney or Tokyo or, when London wakes up in New York, you see them piling again and again into the greenback for this reason. There is nothing like it when crisis hits.
Ruth, just to take the other side to that, is the dollar acting like a haven, or is it just markets were not positioned and just simply squaring positions? In other words, how do we think dollar moves from here now that we've sort of reset?
Yeah, it's a great Yeah, absolutely. And that's a great question because everyone is game planning what the fallout ultimately is going to be for markets from the Iran conflict. So the dollar is obviously on 89% of all trades. It dominates world trade. So do you continue buying it when it's had such an amazing bounce? But you're right, David, in the sense that, going into this conflict, people were pricing in Fed cuts. People were pricing in a weaker dollar for 2026. Now, a lot of those bets are now upended. Hedge funds, in fact, have pared back their bearish dollar bets after the conflict. So the question is, do you continue bidding on the dollar? As long as there's that safety bid, we will continue to see short-term dollar upside. But how long this continues? Well, if oil continues to flow and the conflict eases, we could see a bounce down lower in the dollar.
Ruth, thank you. Ruth Carson there, our chief correspondent for FX and Rates in the Asia Pacific. Quite a busy day, of course, for their team this Monday. Oil prices, we talked about this front and center across the curve. We're now trading at 113 on Brent and West Texas. You have major Middle East producers now curbing production. There's just storage has now become an issue, given, of course, some of the transportation issues there. And shipping issues. Laura Davison is here with us, our politics editor, to take us through the latest. What's caught your eye in the last 2 hours?
So a couple different things. One, just the sharp market reaction that we've seen as Asian markets have opened. It feels like Liberation Day all over again, of just when you're seeing sort of markets in free fall. Question is, how does Donald Trump interpret that over in the White House? I think that the White House has not been quite prepared for kind of the steep market reactions that we've seen. That was ultimately what got him to pull back some of those tariffs. Will that have the same effect? Trump has repeatedly gone to social media over the weekend and says, look, oil prices are going to fall as soon as this is over. When is that? That's a good question. Also, his most recent messaging tactic has been, this is just a small price to pay to invade Iran and take down this enemy of the U.S. This is a sort of a question, though, is if U.S. consumers are suddenly paying $5-6 a gallon per gas at the pump in an election year, he has all his allies on Capitol Hill who need to run for re-election here in the next couple of months. Does this suddenly really change the calculus for Trump on a war that is not popular? 60+% of Americans say they disapprove of this conflict.
Yeah. It's interesting you mentioned the moves are similar to like Liberation Day, where when it comes to trade policy, I think the U.S. has a better control of this, right? We're coming out of a war, ending a war is much more complicated than that. You talked about possible off-ramps moving on. Now that we do have a new Supreme Leader, which is the son of the former, what would we look at in terms of potential off-ramps moving forward now?
There's a couple different things. Trump, has said more recently that he wants regime change. This leader is not the regime that he wants to see in place. But he's also started to speculate that maybe he's just going to have to move on from that, and isn't going to be able to have control. In that case, he's going to be looking for some other victory, some sort of other tangible thing to say. Look, we were able to debilitate Iran's military capability or nuclear capability. That's why we're seeing discussions happening, in the military level, the U.S. military side. Is there some sort of like special forces operation, send in a small number of ground troops, be able to take out some of the enriched uranium or nuclear supplies, but also a tacit acknowledgement that what they've been able to do from the air yet hasn't worked, and this is a much riskier operation, which if this were to fail would almost certainly escalate this conflict and take it into a complete unknown.
Yeah. In an election year too. Laura, thank you so much. Laura Davison there, just laying out for us scenarios, not so much specific outcome because it's very hard to grasp at the moment. This goes into the other top story, obviously China and how China reacts as it pertains to its energy mix. And I think what's interesting too is the inflation numbers came out about 40 minutes back, and we did see a pickup to 1.3% there. And you got to wonder now within the energy space in China, what then shows up domestically and in what form, right? And what part of the supply and value chain that shows up upstream, or do consumers feel it in China, given that China is a net oil importer and also a net gas importer?
Emphasize again, it is free to join my community. The stocks I share are also free. The techniques and strategies I teach are also free. So please don't ask me if I charge a fee, and don't say it's a scam. I only need popularity and word of mouth, not the so-called membership fee. If you want to get the stocks I offer, please join me first. Make sure it fits your own ideas, and then buy a little to verify.
An oil importer and also a net gas importer.
Yeah, certainly they are exposed, of course, to what happens in the Middle East. Our next guest is a senior research scholar at the Center on Global Energy Policy at Columbia University School of International and Public Affairs. Erica Downs joins us now from Washington. Erica, thank you so much for staying up with us. We've talked about the disruptions that we've seen in this part of the world. I think most of our guests have talked about China being a little bit more better positioned in terms of energy security. Walk us through how vulnerable do you think China is to these disruptions that we're seeing in the Strait of Hormuz?
Sure, happy to do so. So China imports about half of its crude oil and almost a third of its LNG from the Middle East. Almost all of that transits the Strait of Hormuz. So that's a lot of oil and LNG that's not getting to China right now. However, China does have some tools at its disposal to manage disruption in its supplies from the Middle East and through Hormuz. And the main one is its strategic and commercial oil reserves. China has been building and filling strategic and commercial reserves for over 2 decades, precisely to be prepared for a moment like this. China has about 1.4 billion barrels in storage. So even if all of China's crude oil imports from the Middle East were cut off for the next 6 months, China does have enough supplies that it would be able to cover that.
Okay, so can we make the assumption minimal disruption?
So I think if China does choose to draw down its reserves, yes, minimal supply disruption. LNG is a little bit of a different story. My understanding is that China's natural gas storage is not on par with its oil storage. However, if you look at China's LNG imports from Qatar, then that counts for almost all of China's LNG imports from the Middle East. That's only about 6% of China's total natural gas supplies, and that would be imports plus domestic production combined.
Right.
How do you think this crisis does affect the energy transition that China is trying to undergo right now? Where are we in terms of the timeline here? Do you think that the situation in Iran could actually shift or accelerate that shift towards renewable energy and really reduce its dependence on the Middle East?
So I think the current crisis in the Middle East absolutely indicates China's big push to electrify everything, notably road transport. And I would not be surprised if we see the turmoil in the Middle East prompting China to sort of be even bigger and bolder in terms of accelerating its move to cleaner energy and to continue to electrify everything.
So in terms of then short-term alternatives, and our reporter just earlier on talked about how, because I think what's interesting is you mentioned gas, and obviously Qatar is a massive global producer of gas, but China also has Russia. I wonder what options China can turn to short-term, so as they avoid dipping into their strategic reserves too.
So I think short term, there probably is going to be a little bit of pain with respect to the disruption in supplies from Qatar. However, China is rich in coal resources, and so switching to coal in the power sector, for example, is something that could be done. And then looking at Russia, Russia is China's largest supplier of natural gas by both pipeline gas and LNG. Right now, however, the Power of Siberia pipeline is operating slightly above capacity, and new pipeline capacity from the Far Eastern route isn't scheduled to come online until 2027. So there's not much that can be done in terms of increasing pipeline gas to Russia. There might be more flexibility on the LNG side.
How are you assessing this Iran conflict and war with other previous conflicts? If you compare it to the Russian invasion of Ukraine, for example, are we seeing the similar types of crisis levels that we've been seeing in terms of the energy impact to this part of the world, or what people are pricing in right now in markets? Do you think it is a bit of an overreaction?
So looking at this again from the perspective of China, we're seeing a larger amount of oil flows to China being disrupted from this crisis than, from the Russia-Ukraine war. So, for Beijing, this is, in terms of China's energy supply security, this is a bigger deal.
Erica, a final question for you. Just looking longer term, and I'm just looking at the range of possibilities, right? And this is obviously something that is largely a tail risk or unexpected. In the event that Iran, under some future scenario, falls under...
Ryan Reynolds here from Mint Mobile. I first ditched big wireless and started using Mint Mobile way back in 2019. Back then, you could get premium wireless for only $15 a month. Today, Mint Mobile's premium wireless has gone up by... Wow, that's it, zero. It's gone up $0 a month since 2019. That doesn't seem fiscally responsible to me, but again, and another, hate math, always hated math. True story, I was in math 10A when I was in 12th grade.
This year, we opened 2 new restaurants while running, how many? 5 others. 5 other restaurants. So we turned to Upwork. We found freelance pros to help with branding, digital menus, even AI tools to streamline operations. It was fast, affordable, and honestly a huge weight off our shoulders. Through platforms like Upwork, we found some freelance creatives who absolutely nailed our logo. Let me show you. Look at our logo. They also helped with our menus. It was amazing. What's really nice is that you only pay for what you need. There's no overhead. There's no long-term commitment. That kind of flexibility is what small business owners need.
The truth is, small business owners can really do big things. You just have
under some future scenario falls under or aligns more with the U.S., how does that change the premium that markets tend to build into that part of the world because of just geopolitical instability?
So I think, again, looking at this from the China perspective, I think that, China would be very sort of pragmatic in, sort of dealing with, certainly the new leader that's in place now, and future leaders of the regime in Iran as well.
Erica, thank you so much. Erica Downs, there, Senior Research Scholar at the Center on Global Energy Policy of Columbia University. Thank you so much. I know it's getting late, so we appreciate the time. The state of markets, global macro movers for you right now. It's Black Tile Day. What we mean by that is you're getting Z-scores where they shouldn't be, which is why this black hue is showing up across these markets. When you get that, it's a very bad day cross asset, across these markets. Right, we're not making this up. Oil prices are up 30% today. There's really no other way to state that, but just as is. So we're up by a third across energy prices just this Monday alone, given, of course, what markets are pricing in. Perhaps worst case, that's the question mark right now across these markets, but this is really causing a massive pain point across assets today.
Yeah, I think a few things that have happened, right? When you have this new supreme leader in Iran is now the son of the former Ayatollah Khamenei, that doesn't really show regime change, and maybe it shows that maybe things are being more prolonged than we think in terms of this conflict. And then you have, OPEC plus producers like the UAE, Kuwait now joining the likes of Iraq and cutting oil production. Yep. So it's not just when it comes to inventories that are now being, continue to be reduced, and there's not much storage around the world here. Strait of Hormuz is still effectively closed, although some of these are wrong linked, or some Chinese vessels have been able to go through, but it's far and few between right now. So there you go. That's why you're seeing $118 for WTI and Brent. Continuing to price in a possibility of this being a prolonged conflict there. Certainly the dollar is the big winner. It reigns king once again here in the face of all this as well. And because of that, I think Asia is definitely feeling the impact once again, Dave.
Yeah, absolutely. Whenever the dollar does this, everything else goes up, including, by the way, gold, right? Gold as the haven play.
Right, benchmarks about an hour, 50 minutes into the cash market session. You have Hong Kong at 25,000. We're below that now. There we go. 3% of the Hang Seng Index. Might be a footnote today, but it's certainly going to be something we'll talk about still, is inflation in China, which came out 1.3% about an hour back. And the question right now, tying those two things together, in what way does the energy price spike globally show up in Chinese markets, and whether or not that's a good or a bad thing?
Yeah, joining us now is Hui Shan, Chief China Economist at Goldman Sachs. We originally booked you on to talk about MPC, but there's only one sort of story that's dominating these markets here right now. Beyond just the energy impact, do you see any sort of broader economic implications for China in the face of this Iran war?
Right, I think from a macro point of view, when you have a purely supply-driven oil price increase, it is stagflationary, right? It's not good for growth, but it will increase inflation. I think the reassuring point is that China did stockpile energy last year, and they probably feel pretty prescient about that decision. And then China's inflation is super low, right? PPI inflation is still negative. So some dose of inflationary impulse might not be that bad. That said, this needs to be managed, and China has stopped exports of refined energy products and so on. So uncertainty is high. I think this reinforces that at the two sessions, at the 15th five-year plan, China has been zero focused on technology and security, and this is exactly why.
Yeah, and so just to tie in the inflation story, that we just got the latest numbers. Good number, 1.3%. It's been a while since we've had a number slightly around that level. What do you make of what's been driving that?
Right, as a data forecaster, macroeconomist, you got to look through the noise and identify the signal. 1.3, a lot of that was Lunar New Year distortion. When you have a very late Chinese New Year, January inflation will be very low, February inflation will be very high. So you're better off taking the average. That will give you somewhere 0.7, 0.8% young year CPI inflation, higher than last year, but it's still relatively muted.
And PPI prices, can we start to see the contractions and the deflation narrow a bit, just given the support that we've been getting from commodity prices?
Right. The good news is that PPI inflation is less distorted by the timing of a Lunar New Year, so you are getting a signal that it's climbing up to less than or less than higher than negative 1%, yes. Negative or positive.
Your small business taxes handled. All your unique deductions found. Keep more money in your business and take taxes off your plate with TurboTax Expert Full Service Business.
Okay, let's say you want to start building credit and you need a credit card to do that. Where do you go? Credit Karma. They help you shop for cards and they show you your approval odds before you apply. Make it simple, y'all. Check out Credit Karma.
Negative 1%, negative or positive. But here, the bad news is that when you have upstream price increasing too much without demand supporting downstream, then whoever is in the middle is getting squeezed. My input prices are rising, but I can't fully pass on to downstream. So I think it's a kind of a narrow path that if you can get a little bit of, think about anti-involution, that's also supply side price increases. So you want to have a bit of a price inflationary impulse. At the same time, it can't be too much. Otherwise, a lot of companies will feel the squeeze in the margins.
So that was one of the things they talked about. It was included in the report and some of the briefings, of course, from economic officials. What they're doing to end this sort of deflationary fights. Did anything stand out to you as far as their efforts on getting inflation going?
I think the narrative, when you read these government report or documents, you kind of get a sense of how important this is, right? How many times they emphasize it, in what context do they talk about in the documents, but also the press conferences. So we get the sense that inflation or stopping the deflationary pressures is important to the government. And that depends on the anti-involution campaign, and that's having some impact. More importantly, PPI is very correlated with the global commodity prices, where he's sitting here talking about oil, but gas prices, other commodity prices are also increasing, especially those are energy intensive. So that will have some pass through. I think we're expecting PPI inflation to turn positive second quarter, third quarter of this year.
So we're disappointed on what came out in terms of consumption. How far do you think these policies will go in really kind of helping this recovery in consumption?
Yeah, in February, we wrote a piece, and the title is "Why has the Chinese government not done more to boost the consumption?" Because that is the number one question investors have been asking us, because it's well known China's economy is imbalanced, too much investment, not enough consumption. Why have they not done enough or more to support consumption? And here we introduce a framework. You got to ask what the government is willing to do, right? There are certain things they're just not willing to do. Large amount of handouts, that's just not in the possibility set, right? And then there's a capability issue. Revenue growth is lower than expenditure growth. You gotta, if you manage your own finance, you gotta prioritize, right? So the prioritization is security technology that left less for spending on consumption, and that's why they prefer things that cost less, right? Interest rate subsidy, that costs you less. Trading program, I subsidize 10%, 20%, you spend $100, so that's cost efficient. Giving you more vacation times, that doesn't cost a lot, right? So you got to think about the way Chinese government are framing, or they certainly want to increase the consumption share of GDP, but there is a limit to what they are able to do.
Did anything else stand out among the many briefings and many numbers that came up with in terms of the budget and everything else?
Yeah, I think the broad brush conclusions, the growth target, the fiscal government bond issues, those are very much in line with market expectations. Yeah. What's interesting is more in the nuances, right? They talk about we want a growth target to be 4.5 to 5, but we will strive for a better outcome. And they talk about the government bond issuance quota. You add up all the numbers, exactly the same as last year, but they're increasing some of the, you can call it policy bank support or other type of resources not in the government bond domain, right? So there's a lot of the little things, and even in the press conference, talk about LGFV, number of LGFV have declined to 70%. So there's the little signals that I find quite interesting in observing.
Okay, yeah, it's a good start one. And we'll see how those stories unfold this year. Wei Shan, as always, thanks so much for to get that nuance first there. Keep trying to economists and Goldman Sachs. An update of these markets. You want to do the damage report? Or should I?
I mean, we got it, right? You take a look when it comes to steep losses, when it comes to Japan, Korea, Taiwan. Vietnam has been joining the fray as well. We have entered into correction territory as well after that 11% slide from highs that we saw just 2 months ago as well. So certainly continue to trace the fallout here, the volatility across these markets as we wake up, of course, now at 110 oil.
Yeah, in fact, I think we're probably closer to 120. We're up 30% on oil prices. It's hitting Japan. It's going to its lunch break too, and we'll talk more in the moment, of course, on what something else that's come up is that regulators have come in discussing stabilization measures when it comes to these markets. More in that part of the story just ahead. This is Tokyo.
It's a supply shock, which means we don't really have the major tools to control it. But it's possible that at $100 a barrel, that we will begin to breach what we call our tolerance range. We reach 4%. And then we have to do something with monetary policy.
That was the Philippine Central Bank Governor Eli Remoloma there speaking to us just last week about, $100 is sort of the threshold here, really, that.
Now college is over. Here comes your student loan debt. Is private student loan debt wrecking your life? You really need to talk to Why Refi. Why Refi refinances distressed or defaulted private student loans that others won't touch. They'll provide you with a custom loan payment based on your ability to pay. Why Refi is not a debt settlement company, and they work with each client.
Really, that central banks in that part of the world are really kind of facing, right? And that do they need to start kind of changing strategy in terms of their reaction functions if we have to deal with triple-digit oil? Does that mean that for sure rate cuts are now a kind of distinct something that's more far away, I guess.
Yeah.
Even the possibility of hikes is something that they really need to kind of contend with now.
It's really changed because for the central banks that were on the fence, clearly hikes are now the next move based on pricing. Those that probably had one or two more cuts on the table have now shifted in terms of the tightening right now. And I think it's, the reaction function across markets becomes even more magnified and exponentially gets to that point even further once you cross $100, whether that's psychologically, whether that becomes a politically untenable, of course, for most. And, when you look at current account deficits, particularly when you look at EM economies, they tend to react a lot more disproportionately, just because of how expensive oil can get and how painful it gets politically, of course, as far as the pump is concerned, right? So I think when you look at how Asia is trading, I think case in point is that markets that tend to import a lot of oil, that tend to have lower GDP per capita, like the Philippines, for example, and why the reactionary function is the way it is that's the way markets are treating it. We're down 5% there. Vietnam's come online. We're set for a correction there. Indonesia is set for a bear market, I believe. Asia is set for a correction. We could go on and on, but yes, we're not doing well across these markets. In fact, Asia right now, have a look at sectors. Everything but energy is up, and of course on the FX side of things, which is the bottom row, second to the right, Bloomberg Asia Dollar Index, we're down 0.5%. That's not a move you normally see for a benchmark on currencies, but that's the time of day we're in right now.
Yeah, rupiah's at a record low. We've been talking a little bit more about the energy complex of things, and certainly we talked about really it's crude, it's LNG, but now you're starting to see a bit more of that spillover in other parts of the markets. And you look at Malaysian palm oil futures, for example, they just started opening up. We're jumping almost 10% for those. So that certainly will have a bit more, impact when it comes to food prices on this whole dynamic as well, and what central banks have to deal with that.
Yeah, okay. Let's take a breath for now. And the headline is oil prices are up 30% today. Where does that leave markets? And is it a good time actually to have the option or the liquidity in the public markets, or is it good to be in the private markets where you really can't do anything because it's things you do give up the liquidity and you have the premium built in there, of course. Well, let's get a sense of really how this is affecting these markets right now, because sometimes really turn to other things like the dollar. In fact, joining us exclusively right now to talk us through the private market side of the conversation from Sydney is Sue-Ann Yeo, head of APAC Private Wealth at EQT. Sue-Ann, good morning, and I was hoping we could have this first conversation under better circumstances, but this is where we are. I'm curious, what is you speaking with your clients, what's the mood on the ground like?
Yeah, so at this point, with in engaging with a lot of private wealth investors, I think a lot of investors are very worried about the volatility in markets. But I think volatility in public markets is actually quite normal at this point, especially with everything that's happening. But at the end of the day, I think given that we advocate a bigger allocation to private markets, I think the strategic asset allocation of each investor's portfolio becomes even more crucial now.
So I'm just wondering, just given what we've seen when it comes to geopolitics, and then there's the wobbles that we're seeing around private credit as well, right? When you're talking about, big firms are limiting withdrawals and all that here, does that in any way shake up the confidence around private markets in any way?
Yeah, so first and foremost is EQT Partners actually doesn't do any private credit, but as we only focus on active ownership strategies. But that being said, it's true that within the markets, I think private credit has grown a lot, and any fast-paced market that's grown that level, there's bound to be a shake-up in quality and dispersion of managers. I think this question actually highlights a very, very important point, which is diversification for end investors. At the end of the day, it's best not to over-concentrate in any one particular asset class or region or sector, and EQT provides that diversification through Europe and Asia being the largest non-US private equity markets investor out there.
Okay, and talk to us about recent flows and whether or not you think, I think you bring up a very good point that what's been taking place in the last week and a half in the Middle East
flows and whether or not you think, I think you bring up a very good point that what's been taking place in the last week and a half in the Middle East might simply bolster the need to just just look for something that's uncorrelated or largely uncorrelated to the public markets. What's the momentum of flows you've seen recently, and do you think we'll get more headed your way?
Yeah. So in fact, we're actually in the beginning of a structural reallocation and structural shift for individual private investors to move their capital into private markets. And in fact, I think at this stage, we're probably only in the single digits or low single digits of portfolio allocation to private markets. And we strongly believe that we are in the early innings and that will start to shift dramatically. And we believe that with the volatility in public markets, there will be a need to look for things that are more uncorrelated, things that can potentially still outperform. And most importantly is that the average company today actually stays private for at least 14 years. And there is a need, if you would like to continue to get exposed to innovation and growth in the markets, that you continue to look at private markets.
Tell us where you're seeing, as flows, right? I think China, I think Taiwan has been a very big source of wealth of late. I'm just wondering, where do you think that sort of wealth is going? Yeah. And maybe tell us about what you're seeing in Australia, where you are right now, too.
Yeah, I think going back to the key point here is the diversification element is something that we hear a lot from investors, that they're constantly looking to diversify what they hold. In Australia, particularly with a lot of them having domestic holdings, a lot of them are looking outwards into what are the potential things that they can diversify into. And so for EQT, as I mentioned, we have a lot of investments in Europe and Asia, and that's a really good source of diversification for them. You mentioned China. China is actually an important piece of our past and future, continues to be an important part of our future as well. So our founding family, the Wallenberg family, actually has a long history in China. And in fact, last year was the 75th year anniversary of Sweden and China. And China continues to be a source of wealth and innovation, and it continues to be an important part of our future as well.
Yeah, so strategically, tangibly, what are you guys doing to expand that footprint in China, given that backdrop?
Yeah, so as it still remains an important part of our future as it is in our history as well. We are exploring ways to work with private investors in China.
Yeah, can you tell us a little more? I mean, people are really anticipating this whole QDLP program. I know you might not be able to share details, but can you tell us a little more what you can at this moment in terms of how you're preparing for this sort of launch in some ways, and what opportunities might emerge from it?
Yeah, I think just with any investors, the Chinese investor is also looking for a diversification outside of what they hold in domestically as well. So this program, the QDLP program, will help the individual investor in China to diversify away from their domestic holdings. And so we are exploring that license at the moment, and we're working on it. So we'll come back to you with a timeline when we have one.
All right, Sue-Ann, we're going to leave it there. Thank you, Sue-Ann Yeo, Head of APAC Private Wealth at EQT, joining us out of Sydney here this morning. Enjoy your trip, of course, to Australia. Of course, private credit is the topic of our big take today, with high-profile blow-ups that are rattling investors. You can read all about it on the terminal if you are a subscriber. That is going to be on Bloomberg.com. Of course, we are still checking markets here right now, right? And just given all we've been hearing when it comes to policymakers, what they're doing when it comes to energy security, what they're doing to stabilize markets, there's plenty on tap.
Yeah, and we're hearing from the South Koreans now. They're calling for active response given to all the market pull. And it's worth pointing out that the South Koreans and the Japanese, even include maybe the Taiwanese, have a very sensitive reactionary function to this types of moves we're seeing, particularly when you get the currency moves like the types we're seeing today, let alone equity markets aside, right? It's really where currency markets and a weak currency and an expensive oil price that has the tendency, that's the transmission effect when it becomes a fundamental, a story that hits fundamentals rather.
Yeah, I think most guests up until now have said this is really kind of a positioning sort of thing, why you're seeing the washout in the Kospi, why you're seeing that washout continue on Taiwan, because they have been doing very well, right? I mean, if you take a look at what we saw in terms of the sell-off last week for Asian stocks, we're down some 6%. You compare that to the U.S., it seems like they're pretty big moves, right? I think the S&P was only down by about 2% last week, but we're still talking about a year to date. We're still talking about gains right now. We might wipe those out maybe today alone. But then again, we are sitting at a pretty more better positioned spot than maybe other markets are. So certainly there is that cushion effect in some ways. But then again, some of these moves are quite pronounced here. And yeah, when you're talking about
alloy sink wrench for tight spaces, a set of 2, 7 notches, fits various hose screw sizes, hose screws under sinks and toilets, space is too tight, no room for regular wrenches, plastic wrenches deform, easily remove hose connections, unscrew the white nut too, any place you can imagine, it can be useful, so practical. If your faucet or toilet broke, you'd pay a lot for repairment. This makes it easy and saves, no more bowing to repairmen. If you don't have one, click the card below to buy. Swipe away and you lose it.
Upwork is the best tool to find and hire high-quality freelance talent. It's free to post, and you don't pay till you hire. Upwork's AI will search through candidates for you and help find the best match for your project. It's hiring, but easy. Give it a try.
Get a match, get moving. Upwork.
about it's sort of a double whammy. When you have an oil price spike, you have a dollar spike, that tends to be a pretty bad cocktail for Asian assets.
I mean, it really is. Let me use a medical analogy, right? So when oil goes above 100,
you turn to medical, yeah.
Let's say same thing. So your reactionary function changes after say a third drink. That's your threat symptoms. For example, say that's your commercial. I don't want to but when oil goes above 100, it's almost like when someone develops diabetes, right? Everything else just gets worse progressively and exponentially from that point in time. So how markets react, how authorities and regulators react, from 95 to 105, that is very different. And I think when you look at markets today, that's exactly, let alone when oil prices are up 30% to 120 bucks. There we go. Anyway, further updates coming up next. This is
Seeing the Middle East engulfed in flames, I want to say that this is a war that should not have happened. Once again, China calls for an immediate stop to military operations to avoid the spiraling escalation of the situation and prevent the conflict from spilling over and spreading.
Chinese Foreign Minister Wang Yi, they're speaking about the war in Iran during his annual media briefing at the NPC. You take a look at benchmarks here, 2% losses are not that bad, I gotta say, compared to the rest of the region here today. So relatively speaking, China is doing okay, but we're still seeing losses of 700 points in the Hang Seng here today. And of course, we're watching very closely what goes on when it comes to the currency, where these dollar moves are getting even more and more pronounced right now.
Yeah, they are. Let's have a closer look at that too, because in terms of what the China role to this, beyond the response itself that we've heard so far, so Wang Yi did speak, even as, of course, the U.S. and Israeli strikes continued on China's strategic partner, Iran, and a signal that the leadership intends to shield its relationship with Washington from the war. Min Lo is in Beijing for us, our China correspondent, to talk us through, of course, what was the key takeaway from that briefing on the weekend here out of the foreign ministry.
Well, David, you heard the soundbite from the Foreign Minister Wang Yi earlier talking about Iran, and he repeated the lines we have often heard from the Foreign Ministry, right? Still providing no more than rhetorical support to Iran. He made a veiled dig at the U.S., saying that major countries should play a constructive role in that conflict. So I think it's interesting the way he characterizes the U.S.-China relations was surprisingly quite measured and even quite optimistic. He said that this could be a landmark year for sustainable development in U.S.-China ties if both sides remain sincere, and he even lauded how the two leaders have so far shown a good example of maintaining interactions at the highest level. He said all that needs to be done now is to continue to make thorough preparation to create a conducive environment to manage the differences. So this is a clear signal that China appears unlikely to want to let Iran overshadow or derail that U.S.-China relations. And Wang Yi also importantly said that head of state diplomacy is irreplaceable. And this is a clearer signal that China will likely want to keep that opportunity to have the face-to-face meeting between Trump and Xi to really iron out all the plethora of issues that they have to discuss. Because of course the stakes are extremely high for China. If you have stable U.S.-China relations, that means lower tariffs, perhaps less tightening of those tech restrictions, and that will have important implications for an economy that is struggling with prolonged deflation and a consumer sentiment that has been very weak so far.
Yeah, you mentioned that stability with the U.S. and China relationship is key. As we get closer to that meeting between Presidents Trump and Xi, there's our sources telling us of this potential Boeing deal that could be quite significant. Tell us more about that.
So we understand from sources that Boeing is close to sealing a deal that would sell 500 of its next 737 Boeing aircraft to China. And if this comes through, it would be a major breakthrough that would end a lengthy drought in Chinese purchases of Boeing aircraft since Trump's first term in office. We understand that separately there is another deal under discussion, the sale of about 100 or so wide-body aircraft that could be concluded later that might not be announced as part of the Trump summit. But again, the fate of this company is going to be closely tied to how the geopolitical winds are blowing, because Trump has been known to use the plane maker to sweeten deals with other countries. And sources are telling us that the deal is not finalized. It could be scuffled into those talks come to an impasse. And of course, that is just one of the items on the agenda. Other things that could be discussed will be China's soybean purchases, for example, and of course the U.S. mulling that consideration to cap the sale of H200 chips to China as well. And of course Taiwan, Foreign Minister Wang Yi mentioned this particularly at the press conference over the weekend. Very strong words warning that any country or individual to try to oppose China's reunification of the motherland shall perish.
We're going to do a study of the actual frame.
And, speaking of strong words, we
have
heard
to do a comparison.
a
Google
fairly
Pixel,
strong
Galaxy S26 Ultra, iPhone 17e,
right direction with
iPad Air, and MacBook Mini.
Bring your credit, debt,
And we'll compare it to the Kindle. We'll compare it to some Chromebooks. So we're still intaking data points, and we're going to roll out the rest of the marketing campaigns. And from there, I have to reach out to the loved ones and, of course, my business partners. So have an amazing day. We'll be right back. Faster you can do this. All right?
TurboTax expert in your community.
Dreams come
They
true.
can do your taxes for you
See you in a little
and get you every dollar you deserve. Local tax experts are here. Hand